Good morning, and welcome to the June 2022 UCLA Anderson Forecast Economic Outlook and Real Estate Outlook Conference. We are hybrid today. We have a small audience as we start to move back to having larger audiences, so we hope to see many of you who are with us virtually today in our audience come September. But we are back to using masks in our classrooms. Hopefully that will end soon as we get to the last end of the quarter. We have a great program today, and really pleased to have you with us. We're going to be looking at the economic outlook in this time of uncertainty. There's a lot of talk about inflation, a lot of talk about recession. We're going to try and dig into the numbers and see what the numbers tell us, what the data tells us. We're going to start off with the forecast program, and the way in which that's going to work is we're going to first have a presentation on our U.S. economic outlook. That will be done by Leo Feller. Leo came to the forecast a couple of years ago after a stint in consulting on the faculty of Johns Hopkins after receiving a PhD at Brown University. And then our own Professor Ed Leamer is going to talk about what does the evidence say about the likelihood of a recession in the next 12 months. And he's going to talk about some of the research that he's done. Ed has been at UCLA for more than 4 decades and was for 17 years director of the forecast, my predecessor and mentor. We're going to do something a little different during Ed's talk because it's a little bit technical. So we, the economists, are going to ask him questions during his talk to hopefully at least clear up what we don't understand. And then I will follow that with the California forecast. For those of you who don't know me, I'm Jerry Nicholsberg. I'm the director of the UCLA Anderson Forecast. So I'll be giving the California forecast. We'll have time for Q&A, and so we'll take Q&A from our audience in person, and time permitting, we'll look at Slido for those of you who are inside the paywall. Put your questions into Slido. William Yu, who is not doing a presentation today, but is monitoring Slido and is going to be in charge of the Q&A. William came to us about a decade ago after a teaching stint in Minnesota and a PhD at the University of Washington. After that, we're going to have a break, and then we have a great keynote and great panel. And so we're really excited for the second part of the program as well. And that's going to zero in on housing. So before we get started, this conference is joint with the Ziman Institute for Real Estate here at UCLA Anderson. We also want to acknowledge Stephen Gordon. Stephen has funded a joint appointment between Ziman and the forecast for a new real estate economist. And so when we get to this point next year, we'll be hearing from them. So that's a really exciting development. Also want to recognize another a major supporter of ours, Edison International and Southern California Edison, who sponsor our Forecast Fellows program, which is a program that helps smart young undergraduates from underserved communities in the Cal State system on a path to becoming economists and to taking all of our places. So we're very grateful for them. Some of the activities coming up, the Alan Matkins UCLA Anderson Forecast commercial real estate survey has just been completed. I'm going to talk a little more about that later, but that will be coming out in about a month. We have the GoDaddy Micro Business Index that just came out, and soon you'll see the Cathay Bank UCLA Anderson Forecast China-U.S. Economic Relations Report. So all of those are coming out soon. We'd like to thank our sponsors and supporters, in particular, our Board of Advisors that was constituted this year, and they have been most helpful so far, and we are appreciative of their support. Our sponsors for today's event, our principal sponsor is RSM. Our platinum sponsors, the law firm of Allen Matkins, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level, Avenue Insights and Analytics, Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Pacific Western Bank, Robert Half, United Airlines, and Wells Fargo, the private bank. At the silver level, Union Bank, the private bank. At the bronze level, Homni Bank, HDR, JLL, Manufacturers Bank, Marsh McClellan Agency, MBK Real Estate, PCL Construction, and at the Bruin level, Gerber Kawasaki Wealth and Investment Management, and WebCore. Our media sponsor is the Los Angeles Business Journal, and our academic sponsor is UCLA Extension. And many thanks to all of our sponsors. As you know, we're a public institution and we couldn't possibly put on these events without that kind of support. So we really appreciate that. And with that, let's find out what's going on with the US economy. Let me turn it over to Leo Feller.
Thank you, Jerry. So good morning, everyone. When I first put this forecast together, Jerry said that it was a little bit doom and gloom, and so I will try to present it with a very happy smile to counteract some of the more pessimistic numbers that are in here. But I'll caveat this to say that it actually isn't all that pessimistic. So what we're actually forecasting is a slowdown in economic growth. And going into 2022, we're looking at 2.8% growth. We had previously been looking at growth over 4%. Going into 2023, 2.0% growth, and into 2024, 1.9% growth. So this is the nature of the economic slowdown. Not terrible, but by the time we get into 23 and 2024, below the trend rate of growth that we normally experience. If you look at this on a quarterly basis, what you see is that we're bouncing back from a small contraction that we had in the very first quarter of this year. That contraction, we think of it as a one-off. So the reason for it is that we had a lot of inventory investment in the fourth quarter of 2021 as businesses were concerned of not having enough inventory for Christmas sales. They over-accumulated inventory. That means that in the first quarter of 2022, they didn't have to go out and accumulate inventory, right? They were just selling off the inventory that they had. That's piece number one. Piece number two that led to that contraction of 1.4% in the first quarter is because we actually had an expiration of government programs that were in place in 2021 to help with the pandemic that expired at the end of 2021. And so government spending, government purchases slowed down as we came into 2022. And the third piece had to do with imports. So imports don't count into our production, right? They're not produced in the US. They don't count as US GDP, which is gross domestic product. But the way that they're calculated in, they come in as our consumption, right? We consume imports. And then when we actually have to do the accounting, we have to subtract away the fact that a lot of the things that we consumed in this very first quarter were actually imported goods from China and from the rest of the world. And so we have to subtract them out. And so that's what really gave us this negative number, right? Consumption was strong, but it was very heavily imports. Government spending slowed down because of the end of expiration of programs related to the pandemic, and businesses were not accumulating inventory. But you see that for the rest of 2022, we actually see this pickup in economic growth, right? So many of you are here in person. Many more who aren't here in person are actually going out and traveling and going to hotels and going to restaurants and going back to ball games and going back to seeing shows. And so we actually are seeing that, the economy, the service side of the economy is picking up very strongly. Searches on Kayak, it's a chart that I'll show you later on, are about 25% above their pre-pandemic trend, their pre-pandemic level, if you look at domestic travel, right? So here in the US, we are searching for flights, we're going out and about, and that's where we're expecting this pickup to happen in the remainder of the second quarter into the third quarter, and then slowing down at the end of 2022. In 2023, you're seeing this dip, right? This slowdown. It's not drastic, it's not a recession, but it's below the trend rate of growth that we normally experience. And the reason that we're forecasting the slowdown has to do with the Fed raising interest rates. So the Fed is raising interest rates, as we're going to show, one of the more aggressively planned rate increases that we have seen, over any course of monetary tightening over the past about 30 years. And so given that we expect the Fed to tighten so quickly, that's going to put a damper on housing markets, that might put a damper on business investment, and that might put a damper on business hiring. And that's the reason for that slowdown, right? And then as inflation rates come down, we expect the Fed to loosen monetary policy just a little bit, and that gets us back to trend rates of growth by 2024. So that's the story for this slowdown that we are forecasting. If you look at where we will be in terms of the levels of GDP, so this chart is basically showing what happened to our economy as we entered the pandemic. That's that sharp decline that you see, followed by the sharp rebound. Then we've been growing and catching up to where we would have been had the pandemic never happened. That would be getting us back to trend line. And now you see that we are actually stopping short of getting to that trend line, right? We had a small contraction this past quarter, and then we continue to grow, but we're growing more slowly. And so we never catch up to this trend of where we would have been had the pandemic never happened, right? The economy is doing well, but it's constrained in certain sectors, right? We talk about labor being constrained, and we have a record number of job openings, over 11 million job openings right now, right? So businesses are having a hard time hiring additional workers to increase supply. We are expecting, even though we got a big rebound in housing, to slow down in housing. And one of my colleagues yesterday, Taylor Marr from Redfin, was talking about how we still have this very big deficit in housing. Even though we've seen this, a bit of a boom right now in housing construction, we still have a big deficit in terms of where we would need to be given our demographic and our population growth. So this right here isn't the signal of a recession, right? It's the signal of slower growth. But there's some concern that a lot of CEOs are pessimistic about not this year, right? Not 2022, but about 2023. So there's this conference board survey that looks at Fortune 500 CEOs. About half of them think there's going to be a recession in 2023. And the concern is that this might lead to a self-fulfilling prophecy, which is if you're concerned about a recession in 2023, you cut back on investment and hiring. And if you cut back on investment and hiring, then consumers are more concerned about whether or not they're going to have a job going into 2023. And so if consumers are more concerned about whether or not they're going to have a job in 2023, they might cut back on some big ticket purchases, like buying a home, like buying furniture, like buying appliances, like buying a car. Now, the caveat there is that the labor market is so strong right now that I don't think there is a very strong concern at this moment in time about whether or not people are going to be able to, have jobs in a year out, right? So when we talk about the unemployment, we're going to see that the unemployment is likely to tick up a little bit as the economy slows, right? But we're still looking at rates of unemployment around, 4%. So let me just mention one more comment here, which is there's CEO confidence, right? So CEOs are pessimistic about 2023. And there's consumer confidence, and consumers are incredibly pessimistic. So this is interesting because if you ask consumers, how do you feel about the economy? How do you feel about going out and buying a car or about buying a refrigerator or about buying appliances? These are longer term purchases, right? These are purchases of long duration that takes a while for people to pay off. If you ask them these questions, they say, I really don't feel good about making these purchases at this moment in time, right? Normally, the reason that people say that is that they're concerned about having a job to be able to make these payments over the longer term. But what's happening now is that consumers are saying, well, I'm not really optimistic about buying these big ticket items because A, they're unavailable, B, they're expensive, there are no promotions, right? And so I'm not happy about being a consumer at this point in time. There was a recent survey done by the Federal Reserve asking about people's financial conditions. And here people say, actually, I'm doing fine financially. I personally am doing okay. I just don't want to go out and buy, these big ticket items. And I think the economy is terrible, but I'm doing okay. Right? And so this is a little bit of a disjoint sentiment that consumers are having. They're pessimistic about the economy, they're pessimistic about being consumers, but they're okay in terms of their own finances. And this was backed up by data from B of A and JP Morgan, where they're looking at people's bank accounts. And they're saying that people's bank accounts actually have more cash than they did before the pandemic. People are sitting on a bigger buffer. People were able to pay off credit card debt. During the pandemic and during the assistance programs that came out of the pandemic. And so consumers are actually, wired and ready to go. They have the money, they have the credit, but they don't have the optimism, and the supply isn't there, right? The goods aren't readily available. They're becoming more available as supply constraints begin to ease. So we have unhappy consumers, but we actually have pretty happy workers, right? So, you look here and you see how quickly the unemployment rate declined. And we're expecting this trough of unemployment this year at 3.5% unemployment rates, 3.4% unemployment rates. These are really low unemployment rates. Jay Powell, the chair of the Federal Reserve, actually described this labor market as unhealthily tight, an unhealthily tight labor market. And so we actually see that the Fed is mentioning that they're going to tighten monetary policy, allow unemployment to increase somewhat if necessary, allow job openings, the ratio of job openings to available workers or unemployed workers to decrease, and slowly get the unemployment rate up to create a little bit more, get this to be a less tight of a labor market. And that should alleviate some wage pressures, and that should alleviate some inflation pressures. So we see unemployment going up above 4%, around to 4.1, 4.2% by the end of 23, beginning of 2024. That's what we consider, as part of the slowdown, the peak in unemployment that we're likely to see. Wages, because of how tight the labor market has been, wages have gone up faster than they have, really over the past decade, the past 20 years. We've had rapid rates of wage increases as workers jump to different jobs, as within the same sector, for example, leisure and hospitality, employers start raising wages. We expect the rate of wage increases to slow down. We don't think we're at the peak yet, right? So wages are catching up somewhat to the inflation that we've experienced. One thing to note here is that we've seen wage increases of about 5.5%, right, for the average worker across the workforce. We've seen inflation over 8%, right? So the average worker is actually worse off, right? They've had faster price increases than they've had wage increases. And that means that their purchasing power has been constrained. But this is very different depending on what segment of the population you look at, right? So workers at the bottom segment, in terms of their income, in terms of their wages, they saw much more rapid wage growth, right? So you saw wage growth in leisure and hospitality of almost 15%, right? Versus inflation overall in the economy of 8%, right? So there's been a skew in terms of which workers have seen wages rise faster than inflation and which ones have not. The answer is for the top 75% of the population in terms of their wages have not kept up to inflation, right? So they're disappointed. And this actually, if you think about the political ramifications of this, who is your typical voter, right? The typical voter, the median voter, you can say, it has been detrimentally affected by this relationship between wages and inflation, experiencing higher inflation than wages. I mentioned this bright spot in the economy. If you look at the black line, this is the searches for domestic travel. You can see that the searches for domestic travel have picked up, right? So consumers are experiencing inflation, they're experiencing higher prices, they are experiencing a robust labor market though, and so they want to go out and travel, right? They're starting to cut back on certain consumption items, durable goods. We had expected this given how much people were buying stuff, and instead people are shifting to buying services. And so what this is showing, and you can see from the trend, is the increase in people buying travel services, right, or searching for travel services and taking vacations. And now about 20% above where we were right before the pandemic for domestic travel. Where we're still hurting is the orange line, which is international travel, right? People are not traveling internationally. That hurts big markets like LA and New York, but it benefits to the extent that people are traveling domestically, markets like Palm Springs and Napa Valley and Salt Lake City and Grand Canyon, where people are traveling to for domestic vacations. All right, so we mentioned that the Fed has met its full employment mandate, unemployment down to about 3.8%. We're forecasting that it'll go down to 3.4%. We've seen labor force participation increase among prime age workers, even among older workers who we thought had retired, like Tom Brady. They are coming back into the labor force and unretiring. And so we're getting lots of surprises where we had expected people to be done with the labor market, enjoying their retirement, being compelled by both higher wages, right? So it's attractive to come back into the labor market because you can earn more. It's attractive because of the availability of jobs, right? You can get jobs in various different sectors right now, given how tight and how much demand there is in the labor market. And you're facing this push of high inflation that's making it more difficult for you to live off of your retirement savings, pushing you back into the labor market. So the combination of those means that we've started to see, and it's still very preliminary, we've started to see a bounce back in older workers, those above 55, coming back into the labor market, right? That should alleviate some of these labor market pressures. So we really do think that the Fed has essentially met this mandate of full employment. Then it has another mandate, which is price stability, and it definitely has not met that mandate, right? And if you saw the op-ed from President Joe Biden this past week, or I guess it was just yesterday, he's talking about how we really need to get inflation under control. The Federal Reserve has free rein to get inflation under control. That is a priority. And so we think that the Fed has had the green light to increase interest rates as much as it thinks it needs to get inflation down. So our forecast is for several increases of at least 50 basis points right now in June, in July, potentially even a 75 basis point increase, which is very aggressive if inflation doesn't begin to come down. And we expect to end the year somewhere between 3% to 3.25% of the Federal Reserve's Fed funds rate that they charge banks, right? That's a really fast acceleration. And there is a risk that my colleague is going to talk about, Ed Leamer, afterwards, is it possible that the yield curve will invert, which is typically a sign of recession? I have in these charts a very minor inversion between the 10-year and the 2-year rate, where the 2-year rate temporarily goes above the 10-year rate. That's a signal that the recession is more likely. Not that a recession is going to happen, but that the probability of one has increased. And Ed will talk about those exact probabilities. The other thing here, since this is a real estate focused conference, is to look at what's happening to mortgage rates. So differently from past tightening cycles, the Fed has been very transparent. My colleague Joe Brisuelis talks it as the open mouth operations, where the Fed goes out and talks a lot about what they're going to do. So they've been very vocal about how they're going to be increasing interest rates. And so this means that the markets can anticipate this. And the mortgage market has already anticipated this and maybe over-anticipated it by seeing rates go from 3% to over 5% just in a matter of weeks, right? A very sharp increase in mortgage interest rates. We are expecting this to continue, right? We're expecting inflation to be a little bit more difficult to get under control than people have anticipated, which means the Fed is going to have to do more open mouth operations, speak more about how they're going to tighten. They're going to have to tighten more aggressively, and that will ultimately take, by late this year, mortgage rates up to about 6 to 6.5%, right? That's a pretty tight mortgage market compared to where we had been, just a few months ago. So while this is a little bit difficult to see, what I want you to get from this is these are all the tightening cycles, how much the Federal Reserve is tightening interest rates at any given point in time, right? We've had this period of zero rates, and you can see how quickly we are expecting them to tighten to this 3 to 3.25 to peaking at about 3.5%, and then starting to have it come down. A lot of people have been talking about, will the Fed be able to orchestrate a soft landing? The Fed is trying to do one of the fastest rates of interest rate increases that they've been vocalizing and telegraphing. At the same time that they're doing quantitative tightening and not only cutting back their bond purchases, but actually reducing their balance sheets, cutting assets out of their books, right? So will the Fed be able to orchestrate a soft landing? That's going to be difficult given the extent of inflation, the extent of tightening that they've telegraphed, and the fact that they're doing quantitative tightening and getting assets off their books. Okay. Every time that we have had a yield curve inversion, almost every time, we've tended to have a recession. Sometimes it can be mild. So this is looking at the spread between the 2 and the 10-year. Ed is going to talk about the spread between the 90-day and the 10-year. And so, the concern is this tends to be a reliable signal. And Ed will explain how this affects bank intermediation and makes it more difficult for banks to make profits, and so they cut back on lending. All right, putting this all together, we really do think there's going to be this somewhat rapid decline in inflation, in part because the Fed is tightening, and it will tighten aggressively if it needs to get inflation under control, and in part because some of the factors that were causing inflation to be high anyway has started to dissipate, right? So we've seen a drop in demand for goods, right? And so because of that, we remember how many ships were, parked outside of the ports of LA and Long Beach, right? Some of these supply constraints have started to ease. Some of them have started to ease for housing construction, right? And so we do expect that inflation will start coming down. It's just going to take, it's not going to be, at 2% rates, which is the Fed's target this year, nor by the end of 23. Perhaps by the end of 2024, we finally get to the Fed's target of 2% rates, right? So this is the slow decline in inflation coming down, but not very fast. I'm going to skip ahead and talk about housing. So because of these higher mortgage interest rates, we think that we've seen the peak of home price appreciation. We think that peak occurred a few months back. Right now, home prices will continue to appreciate, but just at a slower rate. And eventually, by deep 2023, 2024, we are appreciating at slower rates than we had during the past decade, right? So home prices still going up, but slowing down at the rate in which they're increasing. And then we also expect home construction to peak as home demand comes down, right? So our forecast is that we already have builders pulling permits, so they're going to continue building based on those permits, but they're going to slow down the rate at which they're getting new permits. And so because of that, housing construction and housing starts are going to decline, mirroring what we're seeing in existing home sales and new home sales. The reason for this, take a look. This is data from Redfin that Taylor Marr presented yesterday during our seminar. As mortgage rates have risen, given how expensive houses are, mortgage payments have nearly doubled, right? So if you are a buyer right now, you're facing mortgage payments that are nearly twice as high as they were just a year ago, right? And so this means that instead of being able to afford a $700,000 house, all else equal, you're now able to afford a $500,000 house, all else equal, keeping that portion of the payments the same, right? Taylor Marr talked yesterday about how people are adjusting by taking adjustable rate mortgages. They're adjusting by moving even further out and trying to buy cheaper homes. But that's going to affect, which homes are going to be in high demand, and that's going to alleviate some of the pressure on housing prices. Let me just mention that geriatric millennials like myself are going to help keep this housing market strong. This is different than 2008, 2009. We have a wave of geriatric millennials who are aging into their prime home buying and prime earning years. They're going to continue to fuel the housing market. We have not built enough housing for this bubble of people that want to buy houses. And so that's going to likely keep the housing market strong. And we also expect the car market to remain strong. And so the reason for this is that even though interest rates go up, and that typically slows down the auto market, what we're expecting is that because people haven't been able to buy cars during this pandemic, given all the shortages, they're going to keep buying cars because the prices are coming down for cars, even though interest rates are going up, right? So it becomes easier to buy cars. So let me just close saying that we do expect quite a bit of continued economic uncertainty going forward. Household balance sheets are strong, consumer demand is strong. That should help keep the economy in positive territory in terms of growth. But we have lots of risks: rising interest rates, supply constraints related to China's zero COVID policy, right? They're just easing lockdowns right now in Shanghai, but we don't know what's going to happen in the coming months, if there's going to be a need for further lockdowns in China. We're seeing higher raw material costs related to the Russia-Ukraine conflict. All of these pose significant recession risks. And so it's something that we should watch out for, right? We're expecting positive growth, but there's a lot that can happen to make that negative. So in closing, we expect a slowdown, not a recession. And right now, we expect this, we'll call it a soft-ish landing that the Fed might be able to orchestrate. There might be some bumps along the way where the economy slows much more suddenly than what we forecasted. So thank you very much.
Thank you, Leo. And so now we'll turn to Ed Leamer. Ed, where's the recession?
Where is it? Okay. It's in the future. So I want to show you some new charts that illustrate the recession risk. And the reason that these charts are important is I'm not just going to tell you what my assessment of the probability of recession is, but show you the evidence that lies behind it. So you can see it. See it means a visual display of the data, not just a number. So let's start off with a traditional type of recession risk assessment. And it's built off the spread of the yield curve, as Leo has indicated. As he's indicated, I've used the spread between the 10-year and the 3-month. You could do the 2-month. The question is what part of the yield curve matters, but I've concentrated on that part. This is going to be a scatter diagram, and the horizontal axis is the spread of the yield curve, and on the vertical axis is what I'm calling the probability that you're in the last year of the expansion. So the number 1 indicates the historical data is in the last year of expansion, and the number 0 means that it's not in the last year of expansion. So up there at the top, those are the months in which you were in the last year of expansion, namely they take on a value 1, and corresponding to that, you've got the yield curve, which is in the negative area. You see that? So that's supportive of this idea that a negative yield curve is going to lead to early recessions, a recession sometime soon. Whereas on the other hand, these zeros, the quarters in which you were not in the last year of recession, those quarters have typically positive slope yield curves. So that's evidence. I think that you should walk away with a concern from this visual image that an inverted yield curve is going to raise the risk of a recession. And right there in the middle, that's the 50% point. That happens to identify the 0 slope of the yield curve. So you have a flat yield curve with the 10-year treasury and the 3-month treasury the same. That indicates you've got a 50% chance of recession in the following year. Okay, and then where are we now? I'm not in control here. Where are we now? May 2022. That's not the most recent data. That's the average over all May. There's a slope of 1.92, and if you fold that into that image that you see, that's just slightly above 0%. So a slope yield curve that's as steep as it has been in May is not a symptom of an oncoming recession. Hopefully you can see that in that picture, but I'm going to talk about a totally different kind of picture. And here we're going to illustrate the data for the 3 years that precede the recession. The idea is that the economy is like a human being. You have healthy episodes and you have unhealthy episodes. And what we're going to do is look into the healthy episodes that preceded the unhealthy ones, that preceded the recessions, and find out if there are any symptoms immediately preceding the recessions. So we're going to look to see whether the data in the year before recession, which is on the right in this chart, are different from the data toward the left, which are 3 years before. This is the data for the spread that I think it ends in 1969 in December. These are the 36 months of the expansion that ended on that month, in that time. And you can see that the steep yield curve occurred typically 3 years ago, and it tended to get flatter and flatter as the 1960s evolved. That's one episode. There are 6 episodes in total. That's the second one, that's the third one, that's the fourth, fifth, and sixth. These are all the episodes that are complete. There are other expansions, but you try to put them in, the data set is going to be incomplete. I want to have, for statistical reasons, only the expansions that provide complete data. And you can see this, that over here on the right-hand side, there's not only a lower average, but a tighter dispersion of those yields in the middle of the year before recession. So that should be a warning sign. If you're in that range, that should be a warning sign the economy is sick or potentially going to get really sick in the next year, unless something is done to offset that. So in the middle of this, I'll put that average. And then to this, I add the data of the most recent in the most recent period, ending in May 2022. Can you see that? That's on the far right-hand side. Your job is to take that data and move it over to the left so it fits with somewhere in the historical episode. It doesn't look like it fits very well where it's sitting now because all the history has much flatter yield curve than the yield curve that we're experiencing. So let's move that over to the left. Now, that looks better, but I've done a statistical analysis that locates that, and that's what I'm going to describe in just a few minutes. But that's the episode, that's the approach. Visually, I'm going to take the data in the last 12 months. I'm going to try to locate it within the historical data. This looks like it's kind of located in the middle of the second year. I mean, it's very low risk based on the 10-year, on the slope of the yield curve. There's very low risk that we're having a recession anytime soon. And I should add, this implicitly is, this kind of analysis is implicitly based on the assumption that there's a recession within the next 3 years. So I don't go back to the 4th or 5th year in this image. The reason is we lose the data. But let's understand that if you thought that the 4th or 5th were likely, then all these probabilities are going to decline as a result. Any questions, Jerry? Is it all clear? Okay.
Yes, you answered the question about, well, could it be that we're 4 years in before a recession or 5 years before a recession, given this data?
Yeah. Okay, so I don't know if there's any question in the audience, but my hope is I'm leaving behind not a memory of my words, but the pictures, because that captures the data, the evidence. I want you to believe in the evidence that I'm presenting, not just the words that I describe in terms of probabilities. So moving ahead here, this is just the assumptions of what I'm working with. I'm going to act as if those 6 different episodes were a draw out of a 36-dimensional normal distribution, a multivariate normal distribution that has 36 means and a 36 by 36 covariance matrix. If this doesn't mean anything to you, just ignore it. But the problem is if you only have 6 observations, you can't estimate that huge covariance matrix. You have to impose some structure. So the structure I impose is an autoregressive structure. So there's only one autocorrelation that I have to estimate, not the 36 by 36 matrix. And I'm going to act as if the estimates are true when that isn't correct, because the problem of translating the estimates into predicted probabilities is complicated. So let's pretend I didn't say any of that and just move on to the images, and maybe that will all become clear. So that's the mean and the standard deviation of that chart that we were looking at before. We saw the mean, the standard deviation gets a little smaller in the year before recession. You saw that visually before. And those spreads pinch down in that middle. That's just an image of it. So let's translate that into error bands, which one standard error bands, the upper and the lower, so it's plus or minus 1 standard deviation. The mean plus or minus 1 standard deviation. And then ask, suppose we had a yield curve which was 100 basis points in steepness, 1.00. That's compatible with the range that you see in front of you that goes up from the 36 over to, I think it's about 14. That sits inside those standard error bands. If you go outside of that, the data set is telling you not likely. We're going to stick with the 1 standard deviation. On the other hand, if you have a 0, then you're going to be down in from like 12, 14 to over into 1 month before recession. So that's a step towards a statistical numerical analysis that assigns probabilities to each one of these different months. So here's the output that I'm going to create. I'm going to assume, I can hardly read this. I'm going to make alternative assumptions about what the spread is. I think that's 1.96. That's so far away I can't read it. Now that's a relatively steep yield curve too. And associated with that is a probabilistic mixture that tells you which of those months is most likely to have had that number. And the answer, I can't read it, but I think it's like the 30th month has the highest probability. And then that curve moves over kind of slowly, not too much down, but then it collapses when it comes to the year before recession. So that's a probabilistic statement. If you had that steep yield curve, where are we most likely to occur? Most likely in the third year before recession, some chance of the second, but hardly any with the first. If you go with the flatter yield curve, then you're going to shift that curve to the right. And if you go to an even flatter yield curve where it's totally flat with a zero slope, that jumps the probability up dramatically. And then finally, if you have that negative -1, that's where the warning sign, the alarm is ringing out extremely loudly that a recession is just going to come at any point. So this is a numerical characterization of the visual images that you've already looked at. And it depends upon assumptions, statistical analysis, but I think that what you see before you, you made that own judgment about this implicitly when you took a look at those visual displays. So what does that mean about the forthcoming recession? This is capturing that same image that you just had, only averaging or adding overall years. So if you have a steep yield curve like on the left, the probability is very low that you're in the third year recession. That's gray. The blue is the 3 years away. That's mostly blue in that point. As you move to the right, that probability that you're only 1 year away, it gets very much greater and the alarm rises. That's the same image that you had before in the previous slide, just totaled up across all the months, 12 months in each one of those years. So and then this is the placement. This is my view of the probabilistic placement of that 12 of different episodes. So if you looked at just the 1 month, that's the probabilistic placement of 1 month alone. That's what you saw in the previous diagram. If you do 6 months, if you do 6 months, you have to recognize that the 6 month placement can't go all the way to the left because we don't have data to the left of the third year. So I've just put a little slide in there, a little horizontal indicating that we don't know what's happening at that point. But the 6 month is placed near the end of the second year, and the whole 12 month is placed in the middle of the second year. That's exactly where I placed it in that image. That's the same image that we were looking at before, with all the data, with, in addition, the current evidence placed in a way which is most supported by the data, saying that the Wall Street bond market is not indicating that we're in a recession anytime soon. So moving on then, what about the housing starts? You can see the housing starts are not so clear in terms of their behavior. That's the same thing with 6 episodes. And it's true that the starts are declining when you get to the last year, but you can see there's no decline. I can hardly read it because it's so far away, but the actual data is in there as well, the most recent 12 months. And there's no significant decline in housing starts. If you start to see housing starts decline, and that's a source of concern. By the way, my view about the recessions is the Fed creates these recessions in the middle of expansions with low interest rates that get Americans to overcommit early to homes and cars, which creates a fragile marketplace for those sectors. And then when the Fed starts worrying about inflation again and jacks up interest rates, those sectors are pummeled because the lending has already given home loans to people who barely afford it. And with a flat yield curve, banks have to be much more concerned about risk. When it's a steep yield curve, you get intermediation profits because you take loans at low rates, or take deposits at low rates, you make loans at high rate, you make the profit called intermediation profits. That thing flattens out, and there's no more intermediation profits, and risk is what drives the bank lending. And that's why the inverted yield curve is a huge problem. I'm going to say that I don't see any evidence in the housing starts data. And last of all is the unemployment rate. And the problem here is that last 12 months have been badly contaminated by COVID-19. You can see that it spikes up enormously and it comes down tremendously And that's not going to fit into our diagrams because there's nothing like that in the historical record. So I'm going to ignore that historical record and kind of paste the data before COVID with the most recent data and act as if that was what the current situation is with regard to unemployment, and do the same analysis that we had before. And here it is. The unemployment rate tends to be low at the ends of these expansions. That's the current data with that incredibly steep decline in the unemployment rate. Nothing like that has ever occurred. So if you eliminate COVID-19 and you get flat, it's looking like it's a low unemployment rate. That creates a fragile job market, and that raises the risk significantly of a recession.
Ed, let me ask on that chart. So what you've done here is taken out the impact of the pandemic, the big spike up, the big spike down.
Correct.
But the pandemic is still going on, so the unemployment rate is related to labor force participation, which the pandemic has depressed. How does that fit into?
Well, that's a critical question, is that what's the relevance of historical data when it's the current stuff is so contaminated by COVID-19?
Mm-hmm.
And I don't know at this point. I can look at labor force participation, employment to population ratio. I'll do all that stuff later. Today is just an introduction of the evidence behind the probabilistic assessments of recessions. But I agree that what I'm telling you is not airtight. There's all kinds of issues. It's the best I can do under the circumstances. So what does that mean in terms of recession probabilities? I can't read what this slide is. Is that a given unemployment level? I can't read that.
Unemployment rate probability trying to read 2 and 1.
So, but these are 3 different unemployment levels, correct? Or are those different?
0.436, 0.505.
Those are the numbers, but what are they illustrating? What's going from one vertical to another? I can't read it. What's it say along the bottom?
You want to look over there?
3 month, 6 month.
Oh, yeah.
Recent month study.
Oh, yeah. So we're going to look at the data set 1 month at a time. That has a 50% chance that you're going to have a recession in the next year. If you look at 3 months, it's higher. If you look at 6 months, it's much higher as well. So we're taking different segments of the data, of recent data, and inserting it into that slide that we just had. And all of them indicate that it's a dangerous situation that we're in as far as unemployment is concerned. So here's the final comment, conclusion. Well, the most important thing is I try to give you the evidence. I want to let you walk away with seeing the evidence. But the evidence to me indicates the slope of the yield curve makes it highly probable a recession is at least a year in the future, not anytime soon. The Fed's going to make that yield curve a lot flatter. As it becomes flatter, you need to worry more and more about the oncoming recession. Housing starts are really not that useful, even though I wrote a piece for the Jackson Hole conference, Fed Jackson Hole, saying housing is the business cycle, but in terms of predicting, it doesn't give you a lot of early signs of problem, that the housing starts tend to decline only a few months before the recession. And low unemployment rate is a characteristic of the ends of these expansions, but Jerry has suggested implicitly that low unemployment rate might be able to exist for a longer period of time than it has historically, in part because of what COVID-19 has created. So although it looks like the low unemployment rate is raising the risk, maybe that's a mistaken conclusion based on the reality that COVID-19 is contaminating the data set. I'm done. Thank you.
Thank you, Ed. So I'm also looking at a monitor far away, and so Ed, why we need to get the Edison International Forecast Fellows through their PhDs is they'll be able to read the monitors far away. So now we'll turn to California, and you've been hearing a lot about headwinds. And that's what we want to talk about with respect to California. How do those headwinds affect us here in this state? And so I want to begin with, where are we? And what you see in the graph here is the GDP growth rate by state from pre-pandemic, so that's 2019 to 2021. These are the large states, the states that really have a big influence on what happens with GDP. And there are 26 of them, and they advanced too fast. There are 26 of them. These are the ones that grew faster than the US. The US is over on the right-hand side. You see Texas in brown there, Florida in orange, because we always like to compare ourselves in that friendly rivalry with those two states. And then California is in gold. And the fastest growing state over that 2-year period is the state of Washington. California is second. And so the question we want to ask is, what are the headwinds going to do to that? So this image that you have of this guy walking into these headwinds, he's getting there, but more slowly than before? Or is he doing a patented Michael Jackson moonwalk and he's actually going backwards? That's what we want to explore. And so our roadmap for today, we're going to look at tech, government, and logistics, 3 sectors that have been doing well over the past 2 years in California. Follow that with housing, and then kind of all of the other sectors, and that'll take us to the forecast. So let's just jump in with what's happening with employment. This is the change in payroll employment from February 2020, the month before the 2020 recession, to the latest month of data that we have, which is April of 2022. And what you see on the right-hand side are 3 sectors where there's the greatest number of missing jobs, and that adds up to 71% of all missing jobs in California. And those are leisure and hospitality, other services, and education, which education includes support services for education. These are 3 sectors that require a high degree of human contact to deliver the services that are created in those sectors. And so that's where the greatest pain is. They're also low income sectors. But if we look on the left-hand side, who has gained over the last 2+ years, it is logistics. So that's transportation, warehousing, and utilities. And it is one of the tech-intensive sectors, which is professional, scientific, and technical services. So we're going to dig into those 2 first, and let's start with this image. This is the NASDAQ, and it's the monthly change in the NASDAQ. And as you can see, moving your eyes from left to right, over on the right-hand side, it's gone negative, and that has led to headlines like this one from Fortune magazine, which basically says, this crash in the NASDAQ, the downturn in the NASDAQ is coming after startups, tech startups. And we have a lot of tech startups in California, so that's one of the headwinds. Another one of the headwinds is represented by this graph, and this is in the logistics arena. This is the backlog of ships waiting to unload in the port of Shanghai. And the bottom line is the ones that are clustered together. That's the historical record. And if you look at the red, it finally spikes up in this last month. And that's due to the lockdown in Shanghai with many ships waiting to load, which means that there's going to be a surge in the ports of California of ships trying to get in. So we'll come back to that. Let's go to the NASDAQ and employment in tech in California. And you see 2 graphs here. The one on the left-hand side is 1 month, on the right-hand side is 7 months. And the horizontal is the change in the NASDAQ. The vertical is the change, the trailing change in employment. The change in the NASDAQ is year over year. All the dots are monthly, and this is employment in professional, scientific, and technical services, and employment just in professional, scientific, and technical services in California. And if you notice on the left-hand side, there's that dashed red line, which is a positive correlation. but statistically, that's not significant. And these data include the dot-com bust, which was a very different tech industry than you have today. We had a lot of silicon manufacturing, and we had a collapse in worldwide demand for silicon chips. We had a collapse in demand for Y2K programmers, and just technology was very different. If you take those out, then the lack of significance gets even worse, and that red dashed line becomes almost horizontal, showing no relationship. On the right-hand side is after 7 months after the NASDAQ turns down, we do have a stronger correlation there. It's mostly dominated by 2001. And we ran 12 different models. Only some of them showed a significant relationship between the downturn in the NASDAQ and professional, scientific, and technical services. But it's a fairly weak correlation. So it suggests that these headwinds, if we keep having declines in the NASDAQ, these headwinds are going to affect employment. But what has been happening in employment of late? What you see in this graph, the bottom line is the Bay Area and the top is Southern California. And I've added into professional, scientific, and technical services information, which is software publishing, but also entertainment. And there's been a lot of development of technology in entertainment. And if you move your eyes from left to right, you see that we are at record levels of employment in these two sectors, in Northern California and in Southern California. And we've heard in the paper, and this is going back to what Ed said right at the beginning. Let's look at the data, not what we see in the papers. And what we've heard is tech firms are laying off. And the answer is yes, but also tech firms are hiring. And they're hiring more than the layoffs in the aggregate. And that's what we see in these numbers. So all of this suggests that we're going to have a slowdown in tech hiring, but it's not going to turn negative. And that's what we've done with our forecast, is bring down, because of these headwinds, the hiring in tech. But tech also has another impact on California, and that's through the issuance of IPOs and stock options, which fund a lot of state government in the general revenue. And you can see that, went too far, you can see that in this graph. And this is a significant correlation. This is on a fiscal year basis, the relationship between the trailing change in the NASDAQ and general fund revenues. So where are we today? This is from the governor's May budget message. And so on the left-hand side, that's finishing up the current fiscal year. And you can see here, we finish up the current fiscal year with $15 billion in excess funds that are not allocated to anything else, including rainy day funds. And if you add in the rainy day funds, the state is sitting on about $40 billion of cushion. So the state's in good shape. So now let's turn to logistics. For logistics, we want to look at goods traffic through the sea and airports in California. This is seaports, and so it's both Southern and Northern California. The top line is imports, bottom line is exports. You see exports have been declining slightly. That's not going to improve until some of the supply chain constraints are resolved and the rest of the world starts growing again. But the top line, we're at record levels through our ports of imports. And with the surge that we're expecting coming from China, with the easing of the lockdowns, this is going to continue. And that means we'll get some increase in logistics employment, but not the rapid growth that we saw before. Turning to the airports, on the left-hand side is international goods movement of imports on the top and exports on the bottom. This is SFO and LAX. And what you see here is we're at record levels and it's trending up. And things like chips that go into aerospace and car manufacturing, they come by air. And so that means that we're going to have some growth in logistics there. But so that's positive. But the troublesome thing is goods movement at domestic airports in California. It's been flat for some time, for more than a year. And so we don't get growth there. And this includes UPS and FedEx shipments that come in predominantly to Ontario and Oakland. So again, these headwinds say that the growth rates that we've seen in logistics are higher than we're going to see going forward, but they don't suggest we're going negative. Now let's turn to housing. And on the left-hand side, home prices seasonally adjusted, median home prices in California, and no surprise to anyone, they're at record levels. We're going to hear a lot more about this when we turn to our keynote and our panel. On the right-hand side are home sales, single-family home sales in the state. And yes, they've gone down, but if you look historically, they're a little bit above average. So normally you'd think high home prices, pretty reasonable and stable average sales, that should mean that we're going to get a lot of new construction. You saw in Leo's presentation the headwind of increasing mortgage rates and a slowing of the production of new homes nationwide. California, in our forecast, is going to buck that trend, though slightly, for several reasons. Number one is we have quite a number of homes that were destroyed in the horrific wildfires, and they take time to rebuild. As for example, the Woolsey fire was in Los Angeles was November 2018, and only about 20% of the homes have been rebuilt there. So it takes time, and that's going to be part of the reconstruction that is not as sensitive to interest rates. The second is the passage of bills in the state legislature making it easier to build duplexes and ADUs. And of course, an ADU in your backyard means that you can afford a higher home price if you rent that out. That those have gone through. We heard yesterday from the chief economist at Redfin that they studied this in Minneapolis when Minneapolis changed the zoning regulations for single family homes. And the first year, not much happened. The second year, not much happened. The third year, they saw a real impact of that change. That third year for California is going to be the latter half of next year and into 2024. And then the third reason is that California's homes are expensive. And that drives people into renting, and in particular, renting multifamily homes. And the headwind there, of course, is again, interest rates. But we do a survey in conjunction with the law firm of Allen Matkins of 8 markets in California. And it's a survey of developers. And among the many questions we ask them are, what are you going to do next year? And one of the spaces that we survey is multifamily housing. That survey just completed. So I want to show you what the answer to that question was. So these are all the summer surveys going back to 2012. And you notice on the right-hand side, that data is in the last 3 weeks where the developers had full knowledge of the interest rates. And they're saying a greater percentage of them are going to start new projects in California, new multifamily projects in the next year than we've seen in years. And one of the questions we ask them is, are you going to start one project or multiple projects? And a greater percentage than we've seen in 5 to 7 years have said multiple projects. So all of this leads us to say, right now we're at about 1998 in home production, and we're going to see some increase. That's going to take us to about 2001, 2002 in home production, kind of bucking the trend. The numbers are still small, so they don't really impact very much the national picture. But there is risk to this. And one of the risks is there are markets such as Phoenix and Boise and Colorado Springs that seem to be overbuilt and seem to have prices that have gone up above what's sustainable. If you get some collapse in those markets, there could be concern and expectations that cause contagion and affect California. So that's a risk of the forecast, and I'm sure that our keynote and our panel will be giving you many more risks to that. So that brings us to employment. This is the last 3 months. And in the last 3 months, the bars over on the left-hand side are those high human contact sectors. And then we have technology. Those are the two most tech-intensive sectors. They're growing more slowly, and we expect that to continue. And then we have construction and logistics also growing more slowly. And when we fold that into the forecast, we get our conclusions here, which is that tech, logistics, government, construction are going to still drive the California economy, just not as fast as before. That these sectors where we have missing jobs, remember the first chart, the gap is still there, but it's closing. We have coming out of Washington more defense spending and an infrastructure bill that passed. That's not fully built into the forecast because we don't know yet kind of how that's going to be spread out over time, but those will be working against the headwinds. And so just to summarize with numbers, we have good employment growth, but that employment growth is slowing as the US economy slows, bringing our unemployment rate down to 4.1%, and in 2024, a slight bump up to 4.5%. It's higher than the US, but California's always has a higher unemployment rate than the US given the nature of our economy. And we're looking at home production to increase by the end of our forecast to rise into a little over 140,000 units per year. Not going to make a dent in affordability, but it is a little bit of growth. And the constraint there is going to be construction workers, as well as the possibility of further lockdowns in China interrupting supply chains. And then finally, personal income growth, stronger than the US, given the sectors that are going to be growing more rapidly in California. That's the California forecast. So I'll leave you with this image of they're not headwinds, they're Santa Ana winds, but they're bending these palm trees in front of Mount Baldy in the San Gabriels, but they're not breaking them. And so that brings me to the end of the California forecast. And I think we have time for Q&A. And William, do you have any questions over Slido? If you haven't put your questions into Slido, why don't you do that?
Yes, we have some question here. The first question I think is for all of you. There's been a discussion about housing price bubble. So what's your view and forecast about this?
Okay, so I'll start with California. California homes are not overbuilt, right? The reason why California, one of the reasons why California home prices are as high as they are is the demand is very strong. And so it doesn't seem that there's a home price bubble here, although there might be a home price bubble elsewhere in the country. So it's not like in California, it's not like 2006, where you could go in and get a mortgage if you could fog a mirror. Now you have to have a job, and Californians are employed and earning income. And as Leo explained nationwide, people are confident in their ability to keep that employment and keep their income up. Leo, Ed, any other thoughts or contrary thoughts?
I think the concern is just for certain specific markets. So we've had, during the pandemic, some movement to markets like Jacksonville, like Boise, like Phoenix, where prices have risen much more than the fundamentals of the economy of those areas would suggest. I think that's where we might have a concern of prices beginning to come down. For the country as a whole, though, this is very different than 2008, 2009 for the reason that Jerry mentioned, which is the underlying loans are actually pretty sound, right? The credit quality required to be able to get mortgages to buy homes during the pandemic was actually very stringent. People had to show income, proof of income. People were often making cash purchases, right? So different than the overall conditions of 2007, 2008, 2009, where you had a lot of these ninja loans, right? The no income, no job or assets, where people could not back up the value of these homes. Now, it seems like people will be able to pay. It's just a question of is there going to still be this interest in places like Jacksonville, like Boise, given the price increases that these areas have already witnessed?
I have a somewhat different view on this, which is the driver is the bond market. If you only make a 1% rate of interest in the bond, the implicit price earnings ratio is 100 to 1. You have to invest in $100 to get $1 in return. And what we had is a huge price earnings ratio in the bond market compared to equities market and compared to homes as well. So the equities and homes are trying to figure out whether that low interest rate that we've had over the last several years, is that permanent or not? If it's permanent, it justifies very high home prices because you can pay the interest at very low rates. It justifies very high price earnings ratios on the stock market. So you had, the bond market has driven huge appreciation for both homes and equities. Equities have figured out, well, maybe we went a little too far. Homeowners are going to figure out too that they went too far in integrating or processing the bond market. And I think you're going to see significant price declines, not necessarily in the observed prices, because sellers don't have to sell their home and they're going to wait in hopes that they're going to get high prices. So you get the seller's prices for a certain period of time, and those may not go down enormously, but I really think the market price of homes is going to fall significantly as we build into our home price decisions the reality that not only the nominal rate, but the real rate is going to go higher as well.
So I'd like to add, something that I think we want to learn in the second part of our program, which is today we have a much larger percentage of home buyers, particularly in single-family homes, that are investor buyers rather than owner-occupiers. And you would expect their behavior to be somewhat different. An owner-occupier, you own your home, and it's where you live. So you're much more likely in financial distress if you can keep the home to keep it. Maybe not so true with investor buyers. So we'll be interested in learning, did that change the dynamics of home markets?
Can I add one more thing?
Of course.
So people invest in the stock market. Some people think of their buying firms because they have fundamental value. A lot of people think they're going to buy that asset because someone's going to pay more later on. The cryptocurrency is a great example of that. Is the real value of it is virtually nil, but because people thought someone else would pay more later on, you have a huge increase in the value of that. I think home buyers tend to have the same attitude. If the appreciation of homes has been 10% last year, the year before, they think that's a permanent characteristic, and they're willing to pay very high prices. And I think you're going to see cryptocurrency and equities and home prices follow the same route.
So that's also a plug for our December conference, where we're going to discuss cryptocurrency, but all digital currency, including central bank digital currency. Do we have a question from our in-person audience? So anyone?
Jerry, actually, there's a following question, just
Okay.
follow what Ed was talking about. So stock market and cryptocurrency price has been reduced a lot over the past several months. So where this reduced wealth induce reduced consumption in the future and cause a recession?
You think yes?
Yes. So let me. Well, no. I think this will have some effect, but not a very large effect. Which is, we have this wealth effect in the stock market, which is people are targeting some amount of wealth to have at a later point in time. If that wealth has dropped, they now have to cut some consumption to make up for some of the investments that they're not getting in terms of stock market returns. And so, there is the possibility that, people are going to cut consumption somewhat. Now, that said, not that many Americans are exposed to the stock market, right? So if you look at the percentage that actually have a brokerage account's about 25%. It used to be about 12% a decade ago. So this has increased thanks to the likes of Robinhood and, Fidelity and Vanguard becoming more accessible. But overall, it's still a small fraction of the population that's exposed to, to this volatility in equity and I guess crypto assets.
So I would add, I think that's correct with regard to equities, that they don't have traditionally a big impact on consumption, but home prices matter. People when the home prices are appreciating, people taking out loans on their homes and helping them buy new cars, for example. That was certainly the case in that episode of the early 2000s.
And that right now, given that people are locked into these, fantastically low mortgage rates that they were able to refinance into, right, 2.5, 2.75, there's very little incentive for people now to take out equity on their homes and have to do a cash out refi if the rate that they're going to get on a cash out refi is something like 5-6%, right? And so what ends up happening in these environments is that people are not going to cash out some of the equity that they've had, and that's going to make it more difficult to fuel consumption out of this equity borrowing.
And I think particularly it's consumer durables that are traditionally financed out of these equity-based loans. I think you're going to have troubles the housing sector alone is going to create difficulties for consumer durables, but automobiles, I think, will be troubled as well.
So Ed, you think our forecast for automobile sales is possibly too optimistic?
I don't know whether I want to commit to that opinion. That's too specific.
Okay, next question.
So following a question, so given the stock market price decline, so are we expecting more retiree coming back to the labor force?
I mean, possibly. We've started seeing this already, right? So we started seeing retirees come back. But there's two sources of equity that retirees have, right? A lot of them have home equity, where prices still remain high. It depends if home prices begin to fall further, right? That puts them more at risk that they can't, take cash out of the home equity that they have. Given these stock market declines and the inflation that people have experienced, it's more likely that some people who retired early based on their stock valuations now feel compelled to actually come back in, right? So that's actually built into what we think is going to happen to labor force participation. Is older workers 55 plus are going to start coming back into the labor market, both because of the higher prices and because their stock valuations have fallen.
But not coming back to where they were before.
Not to the
These
same
are
extent,
going to be
right.
people who are most impacted by inflation. And
Exactly.
I think, especially for California, one of the wild cards here is what is going to happen to immigration. So California for more than a decade has had net negative domestic migration, meaning people who are living in California moving out of California, but has had population increases because of immigration. Immigration was not entirely shut down, but for the most part, it was over the last 5 years. And our population here has stagnated between 39 and 40 million. And so for the US, but maybe more importantly for California, when it comes to the labor force, what's going to happen with immigration policy in Washington going forward over the next few years?
Okay, so next question is, assuming the Fed were to reduce the inflation in the future from the demand pool side, so let's say that assuming in the future the inflation, higher inflation are all from supply side constraint abroad or gasoline, and do you think, given this kind of situation, where the Fed continue to raise the interest rate to calm down the inflation to, say, 2%?
So the Fed can't really affect what's happening on the supply side in the short term, right? Like it can't lower interest rates fast enough so that firms build fast enough to expand supply, in the next few months to combat inflation. All the Fed can really do is affect the demand side. And so I think my concern is that if we can't get the supply side to actually react, if we're still facing a lot of supply chain constraints, the way that the Fed handles this is by cutting demand even further so that you balance out supply and demand and get rid of some of these supply chain constraints. So I think what has been telegraphed by the Fed is that they're going to keep increasing interest rates. And they got the green light from President Biden on that in the op-ed yesterday, is keep increasing interest rates until you bring demand down far enough so that inflation isn't as much of a concern. I think my fear is that if we continue to have raw material constraints, supply chain constraints like we've had over this past year, is that the Fed will have to increase even further and cut demand even further in order to bring inflation down.
So I have a different view on this, which comes from a study, the study of the 70s. Actually, Larry Summers is constantly doing this in the New York Times, but he's saying that in the 70s, when inflation started to get very serious, the Fed really couldn't do anything until it created unemployment. So in the 70s, you had a spike up in inflation, the Fed creates unemployment, and the inflation drops down dramatically. But then it picks right up again, you get into the mountain, so the Fed creates another recession with inverted yield curves and drives it down, and then along comes the Volcker era when you had another yet huge spike up, and Volcker said, I've had it, and I'm going to rid Americans of any belief in inflation and put incredibly high interest rates, and we're going to have a really serious recession, and that will wipe out this disease, this inflation social disease. So the message that comes from the 70s is the Fed's only hope is to create a kind of stagflation era. And that, I think, is partly the reason the equities markets are very concerned. They think that the Fed doesn't have the possibility of little mild adjustments in demand that are going to alter dramatically our social belief in inflation. And therefore, the Fed is going to be forced into doing something that's very damaging to the economy.
I think fortunately, our beliefs in inflation, if you look at consumer expectations about inflation going forward, right, they're still not out of control. I don't think we've had inflation be the social disease long enough for consumers to have this belief that this is the new era of inflation that we're going to have. But the concern is the longer we have inflation rates of this 8% that we had over this past year, the more it becomes a risk that our assumptions change so that we bake into, our beliefs that we will have consistently higher inflation.
By the way, I think it's businesses you should worry about, not consumers, because in a non-inflationary environment, if I'm running a business and you're competing with me, I'm really fearful about raising my prices because I'm going to lose my customers to you and I could just never get them back. But once we all agree that prices are going to go up by at least 5%, I think I could probably afford a 6% increase. And it becomes a social phenomenon in which your behavior affects my behavior and it gets out of control. I agree, I'm not sure that we're out of control yet, but I think that's a big risk over the next several years.
So let's finish up the time we have for Q&A with, since I have the microphone, I get to ask the last question, oil prices. So oil prices have now gone up to over $120 a barrel. And when we looked at the first spike up in inflation, it was dominated by energy. And so, Leo, what do we have going on with energy prices and why?
Worse before it gets better. And so the reason for this worse is we are in peak driving season, plus China is opening up from lockdowns. All of that creates a lot more demand for oil, which is going to drive up prices. We're still facing constraints coming from Russia, Ukraine. There's still a lot of capital discipline where we're actually down about 15% in terms of oil production in the US versus where we had been right at the end of 2019. The pandemic, if you recall that brief moment in time when oil prices actually went negative in the US in April of 2020, and that brief moment in time where you could fill up your car for $1 a gallon, that actually wiped out a lot of US shale oil producers, and they haven't come back, right? And so, they've come back to some extent, but you're still down 15%. And I think what this means is that we're going to have this era of higher oil prices for a while. The 120, right, it's given the global environment that we're in right now with this war between Russia and Ukraine. It depends on how long that lasts. But my colleague David Schulman as well doesn't think that oil prices come down below, $80 a barrel, even at the end of 2024, that we will have elevated oil prices. So the extent to which it doesn't affect inflation is that we don't expect it to keep going up and up and up, the rate that we saw over the past few months with the onset of the Russia-Ukraine war. But we don't expect it to come down so quickly that it will help alleviate and counteract some of the inflationary forces.
And that brings us to the end of the forecast part of our program. We're going to take a 10-minute break so we can all stretch our legs, but we will start again promptly at 10:05 with the second part of our program and our keynote address for the day. So I will see you in 10 minutes. We're just getting ready to start again. Our in-person audience is coming in from the patio where we had nice treats, nice food and drink. So if you're in person in September, that's what you will get. And welcome back from your refrigerator. We're now ready to start the second part of our program. And we're going to begin with a keynote. A great friend of ours at the Anderson Forecast and here at UCLA Anderson, John Burns. John studied at Stanford and is a Anderson MBA in the late 1980s. Spent 10 years at KPMG in real estate consulting. In 2001, started his own firm in order to provide better information to decision makers, and has been the go-to person for all things real estate, particularly in California, for a very long time. And so it's a pleasure, John, to welcome you back to UCLA, and thank you for being here. Look at his bio in the materials that you have, and I'm going to turn it over to John.
No, it's nice to be back on campus. I graduated here from '89, met my wife here, and I'm from Northern California, but never moved back. So I love LA and UCLA. 30 minutes to explain everything that's going on in the housing market is going to be a lot of fun. So here we go. Here's how we get at it. We've got about 110 people. We're just trying to figure out what's going on for all of our clients. So our clients are pretty diversified, more skewed to people that build things than the resale market, but obviously, we pay a hell of a lot of attention to the resale market. We look at it top down, kind of like the UCLA folks do. We've got a chief demographer. We do tons of demographic trends, economic trends, policy changes. I think what makes us a bit unique is we have a bottoms-up approach too. So we've got offices all over the country. We've got put out a 70-plus page report on 100 markets every single month. We're looking at our forecast and adjusting it, and we have clients in all these markets who are saying, hey, you're too high, hey, you're too low, fix things. So our forecasts tend to be pretty accurate only because we're cheating compared to you guys. We change them during the course of the year as we get new information. Like I did not know mortgage rates would be over 5 in June when the year started. We also put all of our clients in a room to debate and learn from each other. And we also do a lot of trend analysis. So we produce a lot of research reports, and we did more than 800 consulting assignments last year. So we just want to feel how we're getting there. This is how we're getting there. Not moving forward. Say loading. There we go. Okay. So I've organized this into a couple pieces. We're going to talk about economic growth. You just heard more about that than I will ever know, and that was really great. But that is more important than mortgage rates, and I think people tend to forget that. My clicker's not working here, which is going to be a problem. Are you moving that, or did I move that? We got a battery issue, maybe? You don't have extra batteries, do you? I got a lot of animation, so if I'm going to have to tell him to move, this is going to get really bad. Yeah, this is not working at all. Okay, different clicker. There we go. You're a genius. Okay, so we'll get through that pretty quickly, but that is more important than mortgage rates. I'm going to call what happened the last 2 years a COVID-induced housing demand surge that we definitely did not forecast and has been very educational. I just got some really great data from the apartment market nationally that I'm going to share with you nationwide that I think impacted the single-family rental market and the for-sale market too. It's basically a huge household formation surge. And then looking forward, what we're seeing is the demand is shifting to rentals. Interestingly, CPI is 30% of CPI is rent growth, 17% of the PCE inflation is rent growth. The Fed is creating more rent growth by raising mortgage rates because they're creating more demand in the rental market. So I know and they control mortgage rates now too, which we'll get into that. And as I see the home prices, I mean, we have insanely low levels of supply, insanely low levels of supply. So as you hear these headlines about, well, the listings is going up, I mean, they need to triple just to get back to normal. So just keep that in mind, and we'll go through this. So the economic growth here is, we started the year with unprecedented wealth. I'm showing it here by generation for the silent generation in blue, the boomers, 72 trillion in wealth, Gen X, 34 trillion, 9 trillion millennials. I'd like to know how much of that was crypto, probably quite a bit. But that's what we started the year with. People were really rich. And on average, they had 3 times as much cash in their checking account as they normally do. At all levels, we've seen this. Somebody usually has $1,000, had 3. Somebody usually has $20,000, had $60,000, and they've been locked up and ready to go out and spend it. So that's what's driving demand. And this is the 2 measures of inflation, CPI and core CPI. I mean, we haven't seen this since the 80s. Mortgage rates, this goes back to 1973, have only risen 50 basis points or more 5 times since 1984. So, and you see those red raises there, they really weren't that much. Now I'm talking about, there were maybe some 6-month periods where they increased more than that. But look at what happened at the end here. We went from 3 to 5.3. That's the biggest spike we've seen really going back to the late 70s or 1980. So when we started the year, and I think this is important to look at, the blue piece is the 10-year Treasury. It was at 1.8, and then mortgage rates were trading at exactly the historical average of 1.7% above the 10-year Treasury. Why does the 10-year matter? Because a buyer of mortgage-backed securities buys a pool of mortgages that on average usually pays off around 10 years, because somebody refinances after 1 or moves, somebody holds onto it for 30. It's looked at as similar to a 10-year security, so it trades at a premium over the 10-year Treasury. Well, fast forward to April, the 10-year Treasury was up 100 basis points, so of course mortgage rates went with it, but then the spread grew to 2.2, so mortgage rates actually grew even more than the 10-year Treasury did, because when that happens, one of the things is people are far less likely to refi, so maybe it becomes more like a 13, 14, or 15-year security, and people are going to be holding it for longer. See some people taking photos. I'm going to PDF these, and anybody who wants a copy, just email them to me. I'll have my email at the end. It's jburns@realestateconsulting.com. Okay, there we go. So here's where we were as of a week ago. We're at 5.3. We're back down to 5.1 now. I can look into the futures market for the 10-year Treasury, and the futures market is saying we're expecting 3.3 by the end of the year. So that's what the bond market is telling us. You skipped over really quickly, Leo, but you were showing 6.5 mortgage rate on your chart. I want to call you out on that one. So he's calling for a much higher mortgage rate year end than the bond market is, unless the premium blows out to 300 basis points, which actually is what I think you were calling. Which is fascinating. And that could indeed happen because the Fed is going to actually start controlling mortgage rates here and stop buying interest rates down. So that may be part of Leo's thesis. Rising rates, though, this is a white paper we did in 2016, doesn't kill the housing market when the economy continues to grow. So if there were 7 times, some of these were 6-month periods, some of them were 18-month periods where interest rates ran 1% or more, sales never fell more than 10% because the economy was still growing. And that's what we're seeing is people adjust. Okay, I got to buy a smaller house. Okay, I got to go 5 miles further from work. You know, I still need a place to live, or I got to move to Boise, which we're seeing a lot of that too. That's what happens. So it's really the economy, it's not mortgage rates. Now, one of the reasons mortgage rates get so much attention, though, is the stocks in the industry react violently to changes in mortgage rates. So if you're playing the stock market, it is about the stock, not the economy. But if you're in the housing business, it's the economy. So as they said earlier, most Fed hikes end in a recession, not all of them, but when they brought inflation down 4% or more, which is not that often, it's always ended up in a recession. So I'm going to take a bit of a contrarian view. I'm going to say, I'm just going to go with history and say we're probably going to have a recession because that's what usually happens. I'm the CEO of a company too. I agree with the other CEOs, the 57% who say we're likely to have a recession. We're seeing things in our businesses that aren't in the data. We're seeing far more wage growth than is in the data. Businesses are over ordering like crazy right now because nobody wants to be caught short with inventory. And what is going to happen at some point is everyone going to say, you know what, I got enough inventory. In fact, the industrial market is booming because they're storing stuff. And CEOs are saying, you know, I'm ordering too much. My clients are ordering too much from me. At some point, that's all going to slow, and that could cause a recession no matter what the Fed does with interest rates. So I'm going to bet that there's something you can't quite see yet, that when the tide's going out, as Warren Buffett says, you discover who's been swimming naked. And it's people with a lot of debt and businesses with a lot of debt that are being exposed. There are banks, in fact, the debt against stock prices entering the year was the highest percentage ever, higher than in 1929. I think the Fed is telegraphing things as you articulated, because they're trying to figure out, is there another Lehman out there? Is there another AIG out there? Is there another Orange County who's got a mark to market and file bankruptcy? What's going on before I actually raise the rates and educate me? And that's why they talk to so many people. So I think they're getting a bad rap for moving really slowly. I think they're doing this intentionally because of that. So this is the Fed's balance sheet, and I know there's a lot on here. But back in 2007, they had $1 trillion balance sheet. The blue is mortgage-backed securities, and the green is treasuries. And in the great financial crisis, they came to the rescue of the housing market and started buying mortgage-backed securities to keep interest rates down. They bought more than $1 trillion worth of mortgage-backed securities, tapered it a little bit, and then for some reason, I've been saying this the whole time, I have no idea why they continue to own and increase their portfolio of mortgage-backed securities, essentially buying mortgage rates down, especially when home prices were growing faster than incomes. And then, when COVID hit in early 2020, I understand why they did it again, but they now own 24% of all the mortgages in the country. I mean, think about that. The federal government is the lender to 24% of the industry, and they have been announcing for a very long time that they were going to reduce their portfolio of mortgages and treasuries starting this month. I think the number is $95 billion a month, which means they're going to stop buying, and they may have to start selling a little bit too, which means they're going to dump some mortgages on the market, and hopefully people are out there, but rates may go up. We'll see. So if you look at this, the big negative out there, and the Q&A in the last session spotted it exactly, is are we in a housing bubble? Because we do have an affordability problem. And one of the ways we look at this is we look at the housing cost to income ratio. This is the cost of mortgages, property taxes, the whole thing for a typical home buyer buying the median priced home. They put down 10%, that is the average in the country, so they're paying mortgage insurance. We compare that to 125% of the median income, because the typical home buyer in this country makes 125% of the median income. That ratio was at 38% in 2005. That ratio is at 38% right now. So you can't say we don't have an affordability problem. We do. I think the income data is a bit understated, and we'll talk about that a bit later. But we look at this by market compared to each market's own history. And LA is 20% overpriced as we see it, compared to LA's history of being a very expensive place to live. Every market in the country to us, because of the rise in rates, and don't forget, we had 19% price appreciation too over the last year, on top of some appreciation before that, has created a big affordability problem. That being said, and the folks from Berkshire Hathaway who are here will acknowledge this, the demand supply imbalance has just been insane. The number of people who want to buy a home has been far exceeding the number of people that are willing to sell their home. The stock market has really punished the housing stocks this year, but in March, 72% of resale homes, and this is the survey that they participate and others participate in, are getting multiple offers in March, 64% in April. We just released our survey for May, so we don't know the May data yet, but what we're hearing is, hey, I was getting 5 offers on every listing, now I'm getting 3. Well, you only need 1, and you get a great price when there's 2 people bidding against each other, so that's why the market's still strong. But I think that demand and supply are going to come back into balance, mostly with demand coming down, not supply coming up. Because who's going to sell their house right now when I'm sitting on a house with a 3% mortgage? Gee, let's go sell our house and go get a 5.5% mortgage somewhere else. A lot of people are going to stay put, and there is a remodeling boom going on right now. Sadly enough, we're getting a budget on one right now too. It's really expensive. I think that's going to be the future in a lot of economic growth. So let's look at what happened. So there was some talk about the demographics, and we wrote a book on demographics, housing demographics in 2016 called Big Shifts Ahead. But we kept it simple. We looked at what decade you were born. So this is 10-year periods, all the same period. We all know what year we're born, so we don't have to argue whether you're Gen X or a boomer. 37 million people today born in the 1950s. You see the Steve Jobs generation there. The shaded piece means you were born in another country, but you live here now. So that's the foreign born. 43 million in the 60s, 41 million in the 70s. That was the baby bust. Then the millennials, 44 million born in the 80s, 46 million in the 90s. Those folks are all turning 30 over the next 10 years. That is your normal home buying years. So there is a demographic tailwind there, but it's about 2 million more people. So if it's 2 people per house, that would be 1 million more housing units and about a 5% increase in demand. So that's your tailwind. You can see that tapers off because people usually migrate here in their 20s. So that number, the 42 million born in the 2000s should come up a bit, but that depends on immigration policy. But this is more of a call on the for sale housing market than the rental market, which I'm going to come back to that. Everybody's got different numbers. We've studied everybody else's. Our chief demographer has done so much work on this. We think we're short about 1.7 million homes, but don't take that to mean that means we're going to be fine, because that's at a normal affordability level. We may have just priced 1.7 million people out of becoming homeowners or renting with the way we've raised prices and homeowners and homes. And demographically, we need about 1.55 million homes built per year over the next 10 years. We've actually pulled more permits than that in the last year, so we're trending a little bit above the long-term trend, but we got to satisfy some of this pent-up demand first. So this is how we get there. And then if you look at it another way, the vacancy in the country, there's almost 11% of all homes are vacant. I mean, the big one down at the bottom is second homes, but then the big one there in orange is the for rent. You can see that's smaller than usual. The rental market is super tight. That comes to about 2.1 million units less than expected. So somewhere around 2 million, I think, is the reasonable number. Some of the 5 or 6 million, I can spend time on that. Those are overstated. But here's what we got completely wrong. So apartment demand, this is a huge sample size. RealPage collects data unit by unit on, I think it's more than 7 million apartments around the country, so it's massive. There's usually about 300,000 more apartment units occupied every year. Last year, 670,000. I mean, a doubling in the number of people entering apartments. And we were speculating why. Fortunately, Avalon Bay just put this in their earnings report last month and confirmed our speculation that people decoupled. They went on their huge portfolio from 1.8 people per apartment to 1.6. It was too noisy if I was on Zoom all day. I was tight on the Wi-Fi. You know what? I can relocate and I can actually afford my own place 10 miles from the office because I don't have to come in every day. That's what people are doing. And one of the real questions we've got now is, with rents growing so much and people being called back to the office, is this going to have to start to come back? And in New York, it clearly is. But I also think we're going to end up with some sort of hybrid situation where a lot of people are going to be allowed to work from home, either full-time or at least some of the time. So we built 350,000 apartment units, which was an all-time high level of supply, which I thought was going to be really bad during COVID, and it turned out to be way too short. So what happens when demand is here and supply is here? Occupancy goes to 97%. Rents grow 13% per year. 13% rent growth on institutional quality apartments that are probably skewed to the Sun Belt. This doesn't have all the brownstones and all those things out there. There's actually so many older homes in the Midwest, the national number is less than this. But the most amazing thing is the incomes of people who are signing leases today are 13% higher than the incomes of people that were signing leases a year ago. Some of that is strong wage growth. A lot of that is relocation. So I'm bringing my $80,000 income where I was living out to an area where most people make 60 grand, but I'm leasing a nicer place out there and driving some rent growth. So you're really, this has been an affordability solution for the apartment market, and we've seen it in our business too. It's been an affordability solution for the for sale housing market because the debt to income ratios have not gotten out of control. As home prices have gone up, people said, oh, I'm just gonna move a little bit further out where I can get more for my money and I can still afford the payment. And then resale listings, that line over there on the far right is 4.5 months of supply on the market, which is actually, that's below the usual norm, but that's the norm in a good, healthy market. We're down less than 1. I mean, there's like nothing there. And that's what I mean is like, this needs to triple to quadruple to get back to normal. So yes, the headlines are going to be horrible. Oh, supply is up, supply is up. Supply needs to come up dramatically just to even come back into balance with demand. And then on the new home side, this is a survey we do of about 20% of all the new homes sold in the country every month. This is one of our research reports. The builders usually shoot for having about 2 homes that you can come in and purchase and be able to move into in the next 60 days, a standing finished home that's kind of ready to go. And you saw that in the trends here on the left. We are now down to 0.25, or essentially 1 home in every actively selling community. I mean, they cannot get these things finished. The demand has been super strong. So where is all this supply gonna come from in the new home market? Not anywhere here anytime soon. There's a lot under construction that maybe will show up next year if demand really slows. But there's a real lack of supply in the country. And the bears are pointing to this, that we're back up to high levels of unsold single-family homes. Okay, you're right, it's back up to the 2004 levels, but look at the component of this. The red piece of it is finished and ready to move in. The orange piece means it's not finished. And actually the home builders have been holding off selling those homes, waiting until drywall, because they wanted to get some more confidence on where their costs came in before they'd sell the home and list it at a price. So here's the truth on what's going on in inventory. It's really not a problem. And then the first quarter this year was more of the same. 94,000 apartments leased compared to 48,000 in the first quarter last year, which turned out to be a huge year. So these household formations are still going on. Now the question is where? So on all the charts we do, the green is good and red and orange are not so good. So this is the population growth the first year of COVID, from July of 2020 through July of 2021. This is the census data. And you can see California, net people are leaving. I think the data shows that LA County's population has declined like 5 years in a row, partially because immigration is not backfilling the domestic outmigration. You can see New York, Northeast saw some out. Miami saw some significant out. Everybody's flooding back to Miami now, though. And the Midwest and the Gulf states. But the Southwest, the Pacific Northwest, the big cities in Texas, all the Southeast and Florida, even the second home markets up in New England, that's where the growth has been. And I want to show you one market in particular because the data is really easy to show. So this is Atlanta. The MSA here has got 29 counties. So they break it down nice and small. The big population centers are these 4, Cobb, DeKalb, Fulton, and Clayton. Well, all 4 of those lost about, what is that, about 23,000, 24,000 people. I mean, the big population centers lost 24,000. And where did they all go? The next county's out. The biggest for growth was in the next county's out. I've hired 2 employees this way who were told to come back into the office. And I said, no, I've been wanting to hire you for a long time. You can stay there. I mean, it's been a recruiting strategy for folks. And if you've been to Atlanta, I mean, the traffic there is probably worse than it is in LA. That's the reason people want to work remotely, is commuting. So, and you see, I'm sure that's going on here in LA. In fact, the booming market is up in Santa Clarita, where all those new homes are being built now. The discount per mile from the San Fernando Valley to the Santa Clarita Valley on a house was $42,000 per mile. Because the traffic was horrendous, right? Well, then all of a sudden you're told, you know what, you don't have to come to work anymore, or you only got to deal with the traffic 2 days a week. well, where's everybody going? They're like, hey, now finally I can be a homeowner and get something nice and new, as opposed to something really old that needs a lot of work in the San Fernando Valley. So let's talk about where demand is shifting, which is to rentals. So here's how I challenge our team, is that, it's very easy to look at what you can see in front of you, but it's really hard to see what's around the corner, right? So I'm going to be a little bit prognosticating about around the corner here. I'm going to apologize in advance for these next 3 slides. I've got a lot of words on them, but this is what we're struggling with, and I think probably will come up during the Q&A too, but we've looked at each one of these. So there's 12 things that are going on that I can point to precedents, and 4 of them are bullish for the industry and 8 are not. So very low levels of new home supply. It feels a lot to me like it did in 2000 when we had the NASDAQ correction. We were just 10 to 14 years after the S&L crisis recovery. I think we're very similar to that. I get this question in LA all the time, so I just got to throw it out there. There is some generational transfer that is going on. I get it, but remember the median, most people are putting down 10%. So that's more of an affluent LA thing. That's not most of the country or Northeast thing. Very low unemployment. We've seen this 3 times before, so we can look at that. One big thing for our business that we've been extremely lucky is the money that has been pouring into real estate has been absolutely insane. And this was going on pre-COVID. It is accelerated post-COVID because institutions, pension funds, others that need to make a 7% on average yield, where are you going to get that? And you're going to put it in stocks, you're going to put it in bond. I mean, you can't get that in any bond. There's a lot of money being deployed into real estate. There was a question on investors, and we could do a whole hour-long presentation on that. But investors are here to stay for exactly that reason, I believe, until there's a better investment elsewhere. So moving over to the bearish stuff, and how are we doing on time? Oh, we're getting to the end here. Inflation, we can point to that. Stock market route, similar to the early 2000s. The money supply increase, I'm surprised we didn't talk as much about that, but the Fed added 23% of money supply to the stimulus was 23% of GDP in 2 years compared to the record stimulus last time, which was 5% of GDP. That's a hell of a lot of money that people have that is creating demand that is causing inflation. This is what I'm worried about, is rising rates in a bond market are going to expose something. And that's yet to be determined. The conflicts overseas, we're seeing a lot of private equity activity. There's a lot of money flowing into private equity, and they borrow too. So if they were borrowing against one of those unicorn valuations that's no longer a unicorn valuation, then they're going to have a pretty fun discussion with their lender when it comes time to refinance. Affordability and yield curve, which they talked about. But there's the 5 things that are permanently new. 4 of them are pretty bullish. There is so much money out there that is organized to invest in homes. And I know there's a lot of policy people that don't like them doing that. But imagine if that was out there in 2009, how much less home prices would have fallen. I mean, there's a floor now driven by investors. We've got the lowest listings ever. I think technology has sped that up, though. I mean, 20 years ago, you couldn't list your home and get 3 offers that afternoon. Today, you can do that. So maybe the 4.5 months of supply is, maybe we'll never even get there again because things transact so quickly. They talked about it earlier. Dodd-Frank did eliminate stupid mortgages. I wouldn't say it's hard to get a mortgage, though, because the LTVs are very high. The debt-to-income ratios are still very high. Just all the documentation is in place, and you can't get an adjustable rate loan without being able to qualify for a fixed rate loan. Basically, you can qualify for the fixed and choose an adjustable, but they're not qualifying you at a teaser rate anymore. Working from anywhere, I think this is a permanent affordability solution for those that are fortunate enough to be able to work from a computer or a phone. And then maybe we can talk about that later, but the government debt, I mean, every 1% increase in interest rate is creating $300 billion in additional government deficit, and that is something that doesn't get enough discussion, but the Fed is aware of that. And then here are the 12 unique conditions. So The publicly traded home builders have never been better capitalized. They're going to build through this. The surge in household formations. If 5 million people lost their job tomorrow, which would be devastating, there's 11 million job openings. We'd never seen more than 7 before. Student debt relief would help. There's a lot of construction going on that's a new product type that's basically single-family homes designed for rent. The supply chain issues, I'm just going to go through these because I think we started a little late, but here's what I see in LA. And again, the green is good, red is bad. Demand, the existing home sales market never really took off. Job growth is phenomenal, but it's the recovery of the leisure and hospitality market that Jerry was talking about. So I think that's a little bit misleading, or just we're kind of recovering there. Affordability is a disaster, but home prices, according to our index, are up so much that anybody who's been a homeowner during this whole thing is just stinky, filthy rich. And you talked about the construction with wildfires and stuff. There's like no construction in LA. Let's just get that out there. I mean, with 10 million people and 22,000 permits, that's virtually no construction. The existing home sales market boomed last year, but look at it compared to the early 2000s. It's a fraction of it. The home prices grew dramatically. Listings. At the end of April, there were 10,000 homes for sale in the market. That needs to double to 20,000 to get to 2019, and 2019 was the lowest level of listings ever at that time. So, I mean, we need there's like nothing for sale. Every time LA has had less than 3.6 months of supply, home prices have gone up. Every time it's had more than 6 months of supply, home prices have gone down. Right now, we're at 1.3. Again, permits, next to nothing. Home ownership, it's $1,800 more a month to be a homeowner than renting a home, which is higher than usual. It's $2,300 more per month to be a homeowner than renting an apartment, which is higher than usual. Yet I'm pretty bullish on apartments because the market rate of an apartment right now is 11% higher than people are actually paying. So people who are coming up for renewal are actually coming up at 11% below market. Their landlords are choosing not to raise them to the entire 11% because they don't want them to move. They want to keep them in place, but they're still getting good rent hikes, and I think you're going to continue to see that. Blackstone has been raising a ton of money under this inflation thesis, and yes, cap rates are coming up, but you know what? Rents are coming up too, and where are you going to put your money right now? Retail investors are putting money into the Blackstone B REIT to get some of this rental income. So just wrapping it up here, I'm not going to bet against the Fed. The prior Fed chair says it's going to require skill and also good luck to get through this without a recession. The current Fed chair is saying we're going to include some pain. There could be some pain involved. Pain to me means a recession. I'm not going to bet against the Fed. I think there's something looking around the corner that they know is probably pretty highly likely. And that would be the concern for the housing market, not rising mortgage rates. So 30 minutes, we're done. And I'm going to turn it over to the next panel. Okay, thank you. Event, whatever you like.
Okay, before we start the panel, are there questions for John?
Yes.
What do you think the explanation is for the low level of resales on the market?
I think technology is playing a huge role on that because things can transact so quickly. I also think that the low interest, people got a great interest rate and just decided to move. Also in our demographics book, we learned that baby boomers were really like the ones who were moving all the time. Prior generations didn't, the generations after them didn't. So if you look at how long people have been living in their house, it's been trending down for about 30 years.
What about remodels?
We have a huge remodeling part of our business. It is absolutely booming. The building product manufacturers who focus on remodel are killing it. And it was all DIY for the first 2 years of COVID, and now it's flipping to professional contractors.
Okay.
Yes, Arthur.
You mentioned $1.55 million homes need to be built to keep up with the demand. Is that annually or what's the deficit that we are in right now?
Yeah, the 1.5, so our economic growth supports the need for about 1.55 million more homes per year. I went through that slide super fast. It's about 1.1 million households being formed, another 50,000 second homes, another 230,000 teardowns, and then some of the undersupply that needs to get satisfied. And we've been building less than that for about 10 years, but we had to catch up from overbuilding. Now we're finally caught up.
Okay, other questions? Is there a question on Slido? Okay, great. So John had his email at the end of the slide, but you can also find it at John Burns Consulting. John, again, welcome back to UCLA, and thank you very much. And now we'll turn to our panel. Moderating our panel is our own David Schulman. David received his PhD here at Anderson, became an exceptional professor at UC Riverside, our sister institution, and there's even a teaching award named after him because of that. Went to Wall Street, came back to the forecast 16 years ago, and so please welcome David Schulman and the next panel.
Good.
Our panel is going to be on residential real estate. On my immediate left is Anthony Valeri, who's an Executive Vice President and Director of Investment Management at Cal Bank and Trust. Immediately to his left is Martha Mosier. She's the President of Berkshire Hathaway Home Services California Properties, and she covers from San Diego to Montecito on the coast.
And everything in between.
And everything in between, right, in between. Then we have Jan Bruckner, who's a Distinguished Professor of Economics at the School of Social Sciences at UC Irvine. And to his left is Rob McGibney, who's an Executive Vice President and Chief Operating Officer at KB Homes. And one of the things I have to say with Rob has to limit his discussions to what was going on in the market prior to February, right? End
Correct.
of February, because KB Homes is right now in a quiet period, and we don't want him to go to SEC jail, and we don't want his securities lawyers to file an 8K this afternoon because he'll be in big trouble.
Yep. We ended our quarter yesterday, so I've got to be a little careful.
So if that happens, so he's going to be limited to what happened 3 months, the market conditions as of 3 months ago. But I think I could ask this question to all of you. Are you as bullish? Are you more bullish, as bullish, or less bullish from the previous, from John Burns's speech? Where are you on view of real estate? Because he sounded pretty bullish to me.
I don't know if he sounded as bullish. I would agree. My view and view of our team would be that prices will probably stagnate here. I agree with a lot of the components mentioned, particularly the affordability metric. There's a lot of affordability metrics out there. Counting it as a measure of debt of your median income, I think, is the right way to do it. But that supply is so supportive of the market that I think we see on a residential level maybe flat prices here, but a definite slowdown from what we're currently seeing.
Okay.
I would agree with that. We're seeing a slight slowdown on increase in price reduction that we're seeing out there. We're bullish. I do love what I do love what John said, that there's an insane amount of money being dumped into real estate. And I always fall back on what Oprah Winfrey said, not to be glib here, but she said, invest in property. You can't live in your 401k or an IRA. So, there is still a ton of money being dumped into real estate, and it's a supply issue. We have a very low inventory. It really is tough right now to be a buyer's agent in this market right now. But we are seeing a decrease in the multiple counter offers and things like that, just like John said.
John?
So
Jen?
prices aren't going down, that's for sure. They're still going to go up, but maybe not as fast. And that's a good thing, because the price increases we've seen in the last couple of years are pricing so many people out of the market. So we need for things to calm down, and I think that's going to happen over the next year.
Okay, Rob?
Yeah, I generally agree. I mean, there's just no supply, and I think that we'll keep things moving along with what's happening with rates. I mean, obviously that's an impact to affordability, but in the past you may have 10 people lined up to buy a home, and there may be fewer than that now. But I think the lack of supply out there is going to continue to support the market.
Yeah, let me ask a related question, since we mentioned the stock market a little bit in John Burns's commentary. Anthony, are you getting calls from your client, given the recent volatility in the stock market, get me out of stocks, put me in real estate? People coming to you with that, or is it too soon?
No, people are angry and coming to me with many questions. So, yes, there is a question. I don't think we've reached a breaking point, but in the last month, seen definitely a heightened level of investor anxiety about the equity markets, about what's going on globally, inflation, the prospect of additional Fed rate hikes. And at our bank, we do have a bigger real estate investor base, so they go with what they know. But I do think market-wide, you are seeing more interest in real estate as a result of that. And I think prior to this point now, with bond rates so low, real estate was sold by a lot of the Wall Street firms as sort of a bond substitute, rightly or wrongly. That's what it came across as. So I do think there's more interest. As John mentioned, I'm seeing a ton of cash raising for private equity providers in the real estate market, single family homes, and also apartments. So that is, we're definitely seeing more of an interest there. I don't know if it's more recent, but it's growing. It's not going anywhere.
Let me just follow up. Is John Burns had the mortgage rate staying roughly around 5.25, 5.5 range. The UCLA forecast has mortgage rates at 6.5, 6 to 6.5. So my question to you, what's your view? What's the house view where you are?
The house view is, I think we're mostly done with the rise in rates. I mean, the 10-year maybe goes up another quarter basis point, maybe 50 basis points. If you look at the futures market, even where the futures market, John alluded to the 10-year, if you look at the Fed funds futures rate, the futures market thinks the Fed's going to stop in early 2023 at about a 3% overnight rate. That was as high as 3 3/8 in April. I think they're looking at some of the recent economic data and showing that market rates are having an impact. It is slowing the economy. So our view is maybe it's another 25, at most 50, but I think we're close to the peak. And you have to realize just how much rates have increased this year. I mean, a doubling in the 10-year since the beginning of the year, just shocking. So I think we're mostly there. The wild card is, what if inflation goes higher due to energy and some food prices? I think it'll stay stubbornly high, but if it goes higher and forces the Fed to go to 4.5 maybe, that's a real risk. In that case, I think we'll rates higher. But my base case, I think 10-year is close to near its peak.
Okay. Martha, in your world, and let's talk about your world, because Martha handles houses in the 10 and 20 million dollar range, and we're not going to talk about those houses because that's in a different zip code than most of us. But most of your home listings are like in the $1 million to $3 million range, something like that.
Yes, our average sales price is about 1.79 million.
So 1 to 3. So 1 to 3 is probably. What would a 6% plus mortgage rate do to your business, and how would people react to that?
In that demographic, it would be really catastrophic, because it would, affordability is already an issue. And I'm probably the the only non-economist in this entire room. I'm a recovering attorney. So I have to look at this, I kind of dummy it down for myself. And that is, if you're making a payment on a $1 million home at 3%, which everybody enjoy, your payment's $3,700 a month. If you're at 5.5, it's $5,100 a month. So that is really going to have a significant impact on the bulk of our consumers that, we're focusing on. But you need to be aware that the luxury market is booming like it's never boomed before. To give you an example, last year we did $18 billion in volume in real estate. $4 billion of that came out of Montecito, where we only have 10% of our agent population.
Okay.
280 agents generated $4 billion in volume because those are all cash deals, and their average sales price in Montecito is $5 million.
A lot of happy agents there.
Yes.
Rob, your price points are lower. When we talked on the phone, as you said, your Phoenix price points are about $500,000, and your California price points $700,000-800,000, something like for new construction.
Yeah, Phoenix a little lower.
A little lower. What kind of house do you get for that?
We cater to first-time buyer and first-time move up, and in Phoenix for the mid to high 400s, depending on the location. We're typically selling on average a 2,000 square foot house. It's a 3-bedroom, got a loft, 2 bathrooms, and the way we set up our business model, as affordability becomes more challenging, we're not building a lot of specs of choosing what those buyers are going to have that's out there available. And we can shift left, as John was speaking about, on the square footage band and create more affordable homes. So we've got houses that are as small as 1,200 and up to the high 2,000s.
And as of the winter, not recently, what was sort of like the FICO scores of the buyer? What % down payment were people putting down to buy those houses?
It's a surprising number considering the demographic of the buyer that we really cater to. But as in our first quarter, which ended in February, FICO scores were between 720 and 730, and on average putting down almost $60,000.
60, so it's about 10% down.
More than that, based on our average.
Based on your average, so okay. And then they get mortgage insurance.
Depending on the loan product.
Yeah, depending on the loan. In the new construction, is anything different from the house you were building now or then compared to 3 or 4 years ago? What does that typical new house look like compared to, say, 4 or 5 years ago to now?
Structurally, I wouldn't say that they've changed a lot. The fit and finish that buyers select has changed, and it always changes over time. You've gone from the earth tones to the whites and the grays, but structurally, the homes haven't changed drastically. We survey all the buyers in a market to find out, what they're interested in, what they need in their home. What we're seeing is that buyers are using it a little bit differently. They've been getting an extra bedroom because they want that home office, or even 2 extra bedrooms because they need 2 of them. It's really just in the use of the way that they're using their home.
Okay, Martha, what amenities are really selling right now? What do people really want in a home right now? That the houses that your organization is buying or selling?
Well, what we're seeing is, like you said, with the homes, they're looking for expansion opportunities, moving outside of the cities, just much what John was alluding to about the people that are able to remotely work. Some homeowners are looking for 1 and sometimes 2 offices. If you've got a dual income household, they are looking for 2 offices that can work at home. That is probably the single most important aspect. When you look back over the end of 2021, third quarter, it was almost the only requirement was that it was habitable. Homes were selling whether they were, as long as they were habitable, they would sell and get multiple offers. And now it seems that we're seeing a little bit of a trend of a little bit more buyer empowerment now, and they're asking for requests for repairs and price reductions and things like that. So we're seeing a little bit of that.
Okay. Jan, you've done a lot of work on work from home and what that means for real estate location or where people are living. Could you fill us in on your research?
So the economics profession is going bananas over work from home. This is a really important phenomenon, and it's changing real estate markets in many different ways. And so co-authors and I have done research on this, and let me just share with you the 3 different ways in which work from home is going to impact real estate prices. The first way is that people who are living in really expensive cities and have jobs that can be done remotely now have an incentive to move away from those cities. In other words, actually change the city they live in while keeping the job that they already have. So this is the San Francisco high-tech worker moving to Boise. There have been lots of newspaper articles about this phenomenon. And one of the predictions would be that as a result of this sort of relocation, you get downward pressure on prices in the San Franciscos of the world as people relocate. And so our research shows that this is indeed true, that there is downward pressure on prices in cities that have a lot of remote capable jobs and also are full of high-paid workers. So that's one thing. Now, the flip side of that is that the Boise prices are going up, and there have been newspaper articles about this phenomenon, and probably John knows about it intimately. But so there's that's happening too. Now, another possibility, which has been alluded to by several people here, is that people don't change the city where they live, but they change where in the city they live. And so urban economics tells us that when your commuting costs go down, as happens under work from home, when you just go a few days a week to the office, the suburbs get more attractive. And so if people shift toward the suburbs, that's going to raise prices in the suburbs and push them down in the center of the city where people don't need to live anymore to have a decent commute. And so our empirical results show that this is indeed happening. The price gradient, in other words, falling price per square foot as you go away from the center of the city, the price gradient is flattening all across America as people shift toward the suburbs. So that's effect number 2. Effect number 3 is also something that's been discussed here, and that is the fact that people want bigger houses because they're going to have a home office. And so there's sort of an upward shift in housing demand in terms of the quantity demanded. And that's going to raise housing prices everywhere, regardless of the city you're talking about. So I think those are the 3 channels that work from home is working through. What remains to be seen is whether the first channel has legs. In other words, are people really going to be working in a different city than they live in? I think the answer is yes, but we're not totally sure about that yet. The move to the suburbs, that's definitely here to stay as work from home, as a few days in the office per week gets a foothold.
When we had a call the other day, we talked a little bit about the Mondragon Wayland paper, which said that half the increase in home prices that we've seen over the past few years has come from work from home.
Yeah, I just read it.
You read the paper? What are
David
your views
told me
on
about,
that?
I had this paper on my desk, hadn't read it yet, and David said, "Oh, do you know about this paper?" I said, "Well, I'll read it before the panel." And I don't buy it. I think the effect is way too big. There's certainly an effect, but why would demand for home offices raise prices by that much? It just doesn't. It doesn't. It's not plausible. It's a good idea what they did, but I think there's some problems with the methodology.
That was my. I think in direction they're right, but to take into account for half the home price if home price appreciation was 6 or 7%, I could buy it. But if home price appreciation is 20 to 40%, it's harder to buy. Let me ask a question, since people have talked about affordability, and I'd like to talk to Rob and to Jan on what do you think the impact of all this change in California legislation with respect to zoning will be in terms of putting fourplexes on R1 lots and also ADU, accessory dwelling units? What do you think that will be? Would that have an impact on affordability or not? Now, we talked about discussion earlier that Minneapolis, it took 3 years for something to happen. What do you think that'll have any impact on affordability as get some more supply coming from that source? Rob, do you want to go first and then?
Sure. I don't really think it's going to have a significant impact. I mean, I think the idea is good. I think it will create some more units over time, but I think with the under supply of housing in California, that's kind of going to be a drop in the bucket compared to what's needed. And, there's some requirements there, if I understand it correctly, that it's got to be owner occupied for 3 years. I think that's going to put some limitations on it. And then just having, lot size that's big enough to actually build, an accessory dwelling unit, or even split your lot into two and build, a duplex. So I think it's a good idea. I think it will help some. I think it'll create some additional units over time, but I don't think it's a solution to the overall problem.
Jan?
So I think the owner occupancy requirement, which says that the owner needs to reside on the property, even though he or she may be building a fourplex, they need to reside there. I think that's a killer, because, the way for this to happen is for developers to go in and build and buy these parcels and build the fourplex. So I think that's a problem. Maybe there's some way of finessing this requirement, and people are smart and they'll probably figure out a way to do it, but I think that's a problem. But what we need is more densification in California. It's cheaper, housing is cheaper when it's provided in a dense fashion. And that's what we need. So it's a step in the right direction. I also think the ADU phenomenon is really important too. It's a little bit under the radar screen, but if you have all kinds of backyards in LA being filled in with ADUs, that creates densification and affordable housing at the same time. So a student of mine just has written a paper on ADUs in LA County. It's quite interesting, the stuff that she finds, mainly about where they're located and how much they raise assessed property values. But anyway, I think that ADUs are really important, actually, and that they're going to help a lot going forward.
Martha, we had our conversation. You said that was what buyers are looking for is the potential to add an ADU. And then you talked about an interesting wrinkle about where does the owner live? Which unit does the owner live?
Right.
So could we talk about that?
Yes, we did talk about that. And I agree with the other two panelists on this. We are seeing more and more sellers seeking property.
Buyers, you mean?
Buyers seeking property, lot sizes large enough to accommodate an ADU. Also, be mindful of the fact that there are a lot of people that want multi-generational families living and property as well, because their children are unable to afford a home in Southern California. So we are seeing a need for that also. But again, for the owner occupied element, there is a big question out there that we're trying to get the answer to, and maybe this esteemed panel has the answer to that, and that is, does the owner need to live in the actual structure, the home, or can they reside in the ADU? Because there are a lot of people that are attempting to downsize, and they figure, well, heck, I'll live in my ADU and rent out my home because the rental prices are going out of this roof, right? So I can pay my mortgage and then some, and then live in my ADU. So there's a trend towards that as well.
Yeah, but the thing is that also, at the high end is you have folks who have a house, say in Palm Springs or in Montana or Santa Fe, where I live.
Yes.
And they say they live in the ADU in the summertime if they have their place in Palm Springs, and they rent out the big house, or they live in Los Angeles or Malibu in the wintertime, and spend the summertime in Montana or New Mexico.
So does the requirement require that it be your primary residence versus?
So can the ADU be your primary
Exactly.
residence? And then you rent out the big house, and then you don't have to sell the big house and pay a capital gain.
Exactly.
So that could, it could end up in that doesn't necessarily create affordable housing, but it creates there's one more unit.
One other thing you might want to consider is the permit cost for that is really astronomical for the whole permit ADU process. It's really expensive.
So that's telling you the cities don't want it. If they have a very high permit process for an ADU, it's telling you the cities don't want it, and there'll probably be new legislation from Sacramento to limit that, because if you have an extraordinarily high building permit cost to go through all the hassles, it really says the cities don't want it to happen, and they're going to drag their feet or go against the purpose of the legislation.
I also agree with the comment you made about densification, but I think one of the laws that's preventing more of that is the CEQA, and that's really been weaponized to some extent. And I think reforms need to happen there to make that densification a realistic
Yeah. Rob, let me ask you a question. All cash buyers and your product is entry, how many all cash buyers do you see, and do you see investor buyers?
We see a lot of people that are attempting to buy as an investor. The market's been strong enough. We've been discouraging that and limiting the number of investors we have in our communities because, we prefer that they would be owner occupied, and we think that creates a better neighborhood. But there is a lot of demand. We have a lot of people coming and asking for that, but we've limited that so far. And sorry, I forgot the first part of your question.
And all cash buyers, what percent about?
I don't have the exact stat, but I think it runs around 10% for us.
Okay, that's interesting for a first-time buyer market theory to have 10%. And
you probably got parents that are sometimes buying homes for their kids.
Right. Martha, what are you seeing in terms of investor interest and all cash buyers? And let's keep it in the million to the 3 million range, because at the 15 million range, it's an all cash buyer, or they're buying it. It's in theory all cash, but they're doing it with a line of credit, so it doesn't show up as a okay.
Right.
They're really borrowing the money.
Right. We'll also be mindful of the fact that we are all living in a high fire zone in Southern California, and so to obtain insurance on a home over $9 million is next to impossible, not cost prohibitive to get an insurance premium to cover that. So all of those luxury buyers are buying cash because they're not,
But they still have to get insurance.
They do have to get insurance, but it's on their terms versus the bank's terms. So
Yeah, but it's my sense insurance premium, a lot of those areas, what, $60,000, $80,000?
yes, some of them are six figures up in that area.
Yeah.
Like you're insuring $9 million in a high fire zone. You're paying a six-figure premium. Yeah, so it's pretty insane. To answer your question on our cash buyers and our average sales price range-ish, between 1.9 and 2.5 million, we are 14.9% cash buyers.
Okay, coming in, and what are those? What percent of those are investors? Do you know how many are investors? Or
we do. We are right about 12% investors in that, but that varies. That's not always really easy data to obtain because everybody tries to finance as a primary residence, and the rates are much more favorable, as you know. So that data is not always as accurate as it really is.
Okay, Anthony, are you seeing your clients buy homes for investment on their own, or with you guys, or something? Do you do that, or do they do it on their own?
They do it on their own. I don't see a lot of that, but we do have other developers who are just doing it strictly on their merits.
Okay. Now, also, do you supply, for somebody who's an investor on their own, do you supply like lines of credit for them so they could be an all cash buyer, so they could come in, so they could bid all cash because it's based on a line of credit? They don't necessarily have the cash, and you supply the line of credit, and that's equivalent to being a cash buyer.
We do supply a line of credit. The rates are very affordable. I just haven't seen a lot of it going towards a rental or a single family home as investment, however.
Okay.
It's usually for another purpose.
For buying a business, business purpose.
Correct. Or other personal needs or other investments.
Okay. Let me ask Martha, what right now is could you talk about first time on the market right now? Like, where were you like on time in the market 3 or 4 months ago? And where do you think you're gonna, where do you think you are now? And where do you think you're gonna be in 2 months on housing, listings time on the market?
Oh, I wish I could be a predicator for that, but I cannot. What I can tell you is that we're starting to see an increase on days on market. So that's a warning sign on our dashboard that things are slowing down a little bit. The frenzy in the first quarter where you had 6 offers on a home and they were on the market in 6 days and off the market. And then you had all these off-market properties that would sell in a day. It's slowing down a bit on that. So days on the market are really important for us to track. For example, and this is for all of Southern California, in March 17th, the average days on market was 24 days. And that's from the time that the sign goes in to the ground to the time the contract is signed for sale. Today, we're looking at an average, which is actually pretty high. It's not in our footprint because our days on market are a little bit less because we're more of a coastal, we list more coastal properties. The average in California is 42 days on the market. Last year, it was 25 days on the market at this time, year over year. And then 3-year average is we're starting to really look back on a 3-year average on units, on closing, pending units, closing units, and average days on market, because that's a more normalized market. You know, last year was the unicorn market.
Right.
Somebody used the word, I think you used the term unicorn. I love that because 2021 and 20 were unicorn markets. They were some of the best markets our company has ever seen, history of, in the inception of our company. So we look back on a 3-year look back and considered 19, 20, and 21, and the average days on market back in that 3-year time period is 66 days. So we're still in a very, very strong seller's market. The days on market's really important for us to study.
Okay. Zillow is reporting price cuts for the first time in a long time. Are you seeing in your universe, are you seeing price cuts?
We are seeing that, but keep in mind that you still have the sellers that are trying to jump into the market and these pie in the sky sales prices, right? So price cuts do not mean, you know, the cost of real estate's going down. It just means the sellers are becoming more reasonable.
See, the thing is, there's two, as you know, there are two strategies for listing. One strategy is to list something that looks really low in a bargain and you get 50 people showing up.
Right.
And that's one strategy. So then the actual price is well above listing.
Right.
And the other strategy is, well, you have your wish price and you put up your wish price.
Yes.
And maybe hope somebody comes along and takes your wish price, right?
Right, and that's what was happening in the first quarter and last year.
And so those are the people who are cutting prices, the people who had the wish list.
They're cutting prices. We've seen them as much as 20% price reductions, yeah.
Okay. Right now, what market in your coverage area is the hottest, and what is sort of relatively speaking the hottest? Because I think some more markets are still pretty strong. Relatively speaking, the hottest, and relatively speaking, the softest right now in your coverage area.
We are seeing, again, I know not applicable to what we're talking about right now in the average sales price in California, but our hottest market is unprecedented in the luxury market. It's very hot.
By location, by what location?
By location, coastal.
Coastal.
Certainly, if I had an option of taking my finger across a map and picking where I would want to get the listings, it's definitely going to be coastal. Those prices are always retaining their value. There's Brentwood, you know, Malibu, Montecito, La Jolla, Del Mar. Those types of areas seem to be the areas that are holding their own right now.
And what's softer? So relatively speaking, softer?
The high density areas, like you were talking about in, you know, San Diego Gas Lamp, we have a lot of high rises there. We're seeing a softening of that market significantly, and due in part to the fact that people don't have to live in the city anymore, and you know, they're not commuting into the city to work 5 days a week.
Okay. Now the thing is there's very, I want to know if this is true in Los Angeles, just general comments if this is true in Los Angeles and San Francisco. What seems to be going on in New York right now is you have an explosion in rental demand, and rent prices are going straight up. Office rents are going down, buying for a lot of projects. So the argument is people want to live there, but they don't want to work there. Now, is that true for Los Angeles or San Francisco? Does anybody have any kind of comment about that? That they want to live there, but they don't want to work there because they don't want to show up in the office. Because rents are up. Because the thing is you know, what you said is you know, the rent gradients and stuff, you'd expect rents to be falling in New York. But rents right now in New York and rents are, in Los Angeles, rents are straight up. Apartment rents are up 15, 20% going on. So people want to live there, but they're not going to the office. So that's a little dichotomy, it seems.
But you could say that, you know, rents would be going up even more if it weren't for the work from home phenomenon, right?
Yeah.
Because it's downward pressure. It doesn't mean that rents are falling. So in other words, New York rents might be even higher than they are now if it weren't for the fact that people are moving to the suburbs and doing remote work.
Okay. All right. And Rob, all your building is suburban, exurban, right? All the projects you have. Do you have any close-in projects?
We do, yeah. In LA, we've got a few infill projects that we're doing, also in San Diego, but primarily we're building in the suburb area.
How do the infills do versus the suburban or exurban?
Well, again, I can only speak
As
through
of-
the
as
end
of-
of last quarter,
Yeah.
but, you know, everything was selling really well at that time. So we
Okay.
had more demand than we had, you know, lots to sell or ability to get them built. At that
Okay, let's ask construction times. We've been talking about supply constraints, supply shortages. How long did it take to build a house, typical, you know, 2,000-foot, three-bedroom house 3 years ago? And how long is it roughly taking around now, the construction time, from the time you start?
Yeah, on average, it's increased by about 2 months. So we're, you know, 7.5 months now, where it used to be 5.5 pre-pandemic. And it, you know, it varies by market and varies by where we're building. I mean, some markets are more stressed than others, where you've got a lot of demand, a lot of building, a lot of public home builders. But on average, it's up about 2 months.
Yeah. Now, what's happened to buyers who signed the contract and then mortgage rates go up? Well, we can't talk about that now because it happened in the latest
Right.
quarter. So we don't want you to go to SEC
Thank
jail.
you. I don't want to go there either.
Because it's become an issue, is where people enter in a contract thinking a mortgage is going to be 3.5, but you can't really do anything until the certificate of occupancy, and all of a sudden the mortgage is 5.25, and there are issues, you know, there are issues associated with.
Right. There are also some pretty good loan lock programs where you can get people locked in.
You
at
could
an
get 3 or
earlier
4 month
stage.
locks. Can you get more than a 3-month lock?
You can, yes. It gets more expensive the longer out, the further out that you lock. But
So if you got the lock, then
there's
it's
270 and even 360-day products.
okay. Then it becomes a non-issue. Let me see, what else do I have here? When your clients talk about real estate, how do they want to invest in real estate? How do they want to invest?
So when our clients come to us for real estate, it's usually as a buffer or in addition to an existing portfolio of stocks and bonds, and it's more just a diversifier, different uncorrelated asset. From my world, most of the investments in real estate are very diversified, reflecting the universe. So it's not just residential, it's office, commercial, hotel. To get that specific, and there is more interest in it, to get that single family exposure, it's more on the private side, going with the private equity providers, and all of them have some sort of exposure there. And I think that's still an area of focus. Two of the biggest, from a private real estate standpoint, 2 of the 3 largest areas of focus are multifamily and single family. And not only is it an area of interest, but the providers, be it the Blackstones, the Coldwell Bankers of the world, they're working on better liquidity terms. So they're definitely trying to attract more investors.
So you're working through private equity, private REITs, and some public equity?
Correct. Yeah. So some of the publicly traded REITs will behave more like a stock. So it depends on the
Right.
vehicle. There's really any type of exposure we want. We use a semi-public and private fund as more of a low volatility alternative, but there's a lot of exposures to have. I think it makes sense in the current environment, and I think when you look at investors broadly, given for stocks, rising inflation and higher interest rates mean lower valuations,
Right.
and then if you have the Fed pulling away liquidity, there's a lot of headwinds for an equity investor after a 10-year run where returns average 14%. So that's going to come down, and I think competitively, real estate stands out a little bit more.
Yeah, so the thing is on with private vehicles, they use appraisals, which is different from market prices. When I was at Salomon Brothers, when I was running a real estate department, in 1987, we had the stock market drop 22% one day. And here we had the market 20%, took 4 months to go down 20%. It went down 22% in one day. And then what I said about the real estate market is if real estate prices did drop 22% in one day, nobody would know it. Because there's no ticker tape, nothing going on.
Right.
So it may have dropped, but nobody would know it.
Yeah, well, yeah, that's arguably one of the advantages of the private space is it's not mark to market.
It's not mark to market,
right.
even though the market may have moved. And the thing is when real estate volume leads price, as we all know. So when volume really slows down, that's a sign maybe there may be price softness. 6 months from now, it's not price softness today. And typically when the market is down, when volume picks up, it'll lead price by 6 months. First, you'll see a lot of volume. It wouldn't show up in price. The market is clearing at the old low prices.
Right.
And all of a sudden, there's no inventory, and price follows.
We have a general belief for saying that the public markets will lead the private by 3 to 6 months.
Right. So that's sort of the question. All right. So do we have any questions, William, from the audit from out in space? Your mic's not on.
So with cost of
Louder.
with the cost of building being higher due to the supply constraint, are we seeing higher price level for the new home being built?
Well, that's for Rob. Cost pressure is pushing up your prices, basically. That's.
Well, we price to our home prices that we put, we're pricing to market, not to our cost. But the costs are certainly up. I mean, both supply constraints and labor constraints have driven the cost up significantly year over year, 20 to 25% range. So it's significant.
Okay. Next one.
Okay. Next one is Masa. You mentioned about ADU, those kind of things. So how does the not in my backyard sentiment of a neighbor looking at this kind of ADU happening in the neighborhood? What do you think?
That's a really good question because there are so many associations. I'm from Orange County and everybody lives in an association in Orange County. And the ADU laws, as I understand them, the CC&Rs of any HOA cannot impede and infringe on a homeowner's right to erect an ADU on their property. So it's a very, very, it's a state law.
Yeah.
And so they cannot, the neighbors can frown all they want, but a homeowner's well within their rights. And as far as I know, and actually researched this myself to put an ADU on my property, I have 4 millennials. They all want to live in my ADU, but you can actually, the setback requirements and things like that are even adjusted so that you don't have these really strict setback requirements for an ADU. So again, the neighbors can frown all they like, but there's not a lot that they can do if you're within the, within the bounds of the law.
Anybody here in the audience with a question? Anybody in the audience?
I have a question.
Jerry, and then we'll go back to the space.
So you all talked about work from home and people moving out, and Boise was mentioned, for example, and you've seen home prices increase in places like Boise and Salt Lake City and Phoenix at a much more rapid rate than Los Angeles. At some point, that kind of equilibrates, right? When there's premium for living in Boise, the benefit from living in Boise due to the cheap home prices is more than compensated by the extra premium you pay to live on the coast. Where do you think we are in that? And for example, Boise median home prices in the state of Sacramento. Are we kind of at that, or is there still more to go in inland home prices versus California prices?
I'm not sure what to say, or I'm not sure what the answer is. There are 2 types of relocation. One is the work from home relocation. The other one is just people moving to Austin, picking up everything and moving to Austin. And so, as you say, there's at some point people are not going to find it very attractive because Austin prices will be higher. Well, how close we are to that, I'm just not sure. People with a better feel for the nuts and bolts of the market may have a different answer.
Jerry, let me comment on that, and then I'll turn it over. Boise was discovered, but some other city could get discovered. Spokane could get discovered. So if it's not Boise, it could be some other place. And then I'm also very familiar with Nashville. Where I have a house in Nashville, and I got 2 kids there. And it's a lot of New York money and California money coming in, and prices are there. And John's chart had big increases in Nashville. Nashville's been on fire, and my kids have become rich, even though, in a sense, it's because housing was super affordable. I'll give you an example. Housing was super affordable in Nashville in 2014. where my son's house was 3-bedroom, 2-bath, big lot, 1950s construction, call it 220. We bought it for them. Like, by California standards, people die and go to heaven. And 15 minutes to downtown.
Yeah.
And stuff like that. And that today, according to Mr. Zillow, is 540. So that, and by California standards, that 540 for that location and that place, where the people from Amazon's building, Oracle is building for the people coming into there, for Nashville is very expensive. But for somebody coming in with monopoly money or high wage, if they don't have a house in California or Seattle, they come in, that's still cheap. And so there's a way, so my sense is, I think there's a way to go on that relative basis.
Well, I think you also have to think about the cost of living. It's not just the cost of the home. I mean, the gas prices were, that generation that John was talking about, the millennial, that, you know, unless there's some generational transfer of wealth, they don't have the down payment.
Right.
You know how difficult it is for a millennial to put 10% down, and average sales price is 1.7, you know,
Right.
if you want to buy it in LA. So I think the cost of living in those other areas, as evidenced by our rising gas prices here in California, it's really difficult for a younger buyer to buy.
Yeah, because gas prices are $2 lower than here, everywhere,
Yeah.
pretty much everywhere else. Okay, you had a question there.
One more question. You guys talk about the wildfire and insurance, and the audience had a question, just what is the wildfire risk in housing market in California, generally speaking? What do you think, the impact?
So I don't know that it is much of an impact. In fact, for some perplexing reason, fires and floods and things like that aren't deterring the buyers in these high fire zones. What it does impact is somebody that needs to finance a property in a high fire zone, which 3/4 of Southern California is a high fire zone, and the cost of the insurance premium sometimes is cost prohibitive for them. So I think that affects the ability, the affordability, because it feeds into affordability. But in the higher end luxury homes, that's really not an issue for the buyer. They're kind of impervious to, you know, the stock markets and the inflation and things like that. It's not really affecting their buying power.
Okay, is there any question I didn't ask you that you'd like to answer? For anybody? Anybody in the audience? Okay, thank you very much, everybody.
Thank you.
Thank you.
So as we conclude, I'd like to thank our panelists, thank John Burns for giving us great insights as to what's happening in real estate markets. And our next program is going to be in September 21st, so mark your calendar. It should be mostly in person, so come on in. We'd love to see you in person. And before we close, just a few acknowledgements. This program has been joined with the Ziman Center for Real Estate. And I'd like to acknowledge our supporters, Stephen Gordon and Edison International. Our sponsors, RSM is our principal sponsor. Platinum sponsors, law firm of Allen Matkins, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. Our gold level sponsors, Avenue Insights and Analytics, Bank of California, California Bank and Trust, California Steel Industries, Venture Forward by GoDaddy, Pacific Western Bank, Robert Half, United Airlines, and Wells Fargo, the private bank. At the silver level, Union Bank, the private bank. At the bronze level, Homni Bank, HDR, JLL, Manufacturers Bank, Marsh McClellan Agency, MBK Real Estate, and PCL Construction. And at the Bruin level, Gerber Kawasaki Wealth and Investment Management, and WebCore, our academic sponsor, UCLA Extension, and our media sponsor, the Los Angeles Business Journal. And for those of you who are not virtual but are with us, we do have some lunch out on the patio, and we can continue the conversation there. Thank you, all of you, for coming today, and we look forward to seeing you in September. Have a safe, fun, and profitable summer.